It's all related because the number of setups, like we said, is an indicator of the overall market health.
If you define the type of days for yourself based on the homework that you've done, you will stop yourself from yourself.
Price percent change from the open, I think, is an underrated data point.
37% of the move is based on the industry group, 12% is based on sector, and 3 out of 4 stocks follow the market.
Enter when it breaks that range, you can manage risk really tightly, and then it triggers the daily, then it triggers the weekly.
We get the September pullback in the S&P. This name goes into a relative strength phase.
It's acting right. I can let it do its thing, wait for the 21 EMA to cross my cost basis, and kind of switch to my position trading rules. Welcome everybody to now the 7th webinar and now the 10 webinar Ultimate Trading Guide series. We're really excited about this one. Last week we dived deep into weekly routines and screening. We went through a lot of templates for you guys. And today we're going to focus on the daily routine aspect, daily screens that you can run for consistent idea generation. And also we're going to do a deep dive into trade execution, how to actually go ahead and enter trades. And what are we watching in the minute when we're looking to do that, and going through our processes. So welcome everybody once again. Stick around to the end. We've got a lot of great frameworks and topics to discuss, and let's go ahead and dive right in, and I'll hand it over to you, Ray.
Perfect. So today's topic is daily routine and trade execution. Let's get to the agenda. So again, if you haven't downloaded the Ultimate Trading Guide, link is going to be in the description if you're watching on YouTube, or if you're on Zoom, Richard is going to paste it in the chat. 115 pages, 16,000 words, more than 7 frameworks now. So
and completely free.
And completely
just drop the chat.
free. Let's start with quote of the day. So today we'll talk a lot about the daily routine, what you're doing pre-market, what you're doing during the market, and what you're doing post-market to kind of prepare. In last week's webinar, what we spoke about was just more so the weekend routines and how you have to spend a lot of time on the weekends. And then today we'll discuss the daily, the day-to-day management of your business and how that's important. So this quote says, "The secret of your future is hidden in your daily routine." A lot of folks that you will see that are successful in trading seem to have a very specific, organized, set, visualized, routine when market is, when they wake up, what they're doing pre-market, or when the market closes, what are they doing post-market, or even during the market, what are some of the things that they're going to look at. They really have a clear-headed picture so that they're not trying to grab news one day, and then turning into a macro trader the other day, and then turning into a technical trader on Thursday, and then a fundamental on Friday. They're not trying to do all of those things at once. They know what they need to do day in and day out, and that's what we will focus on today. So we've broken it down into 7 steps that you need for your daily routine, and we will go through each of these in much detail. And then the second half of the webinar, we're going to go into trade execution with some examples, recent trades that I placed, and then really break it down and get into the nitty gritty and the details of things right near the end. So before we start, we have downloaded the free Ultimate Screening Guide. This is a new guide that we've put together on the deep view side. It's called the Ultimate Screening Guide. It's a 7 lesson course, and you will receive 7 different emails. And it will go through, it's very similar to the Ultimate Trading Guide, but it's very focused on screening and how you can build different screens, tactical screens, from a daily routine, weekend routine perspective, and then how some of the more accomplished traders, what screens do they run as well. So we cover all of that over a course of 7 emails that will be delivered to your inbox. Link to the Ultimate Screening Guide is in the chat right now, and if you're watching on YouTube after the fact, it's going to be in the description. So this is something new that we put together. I think a lot of you will enjoy it. A lot of effort went into this, especially Richard, forming the 7 lessons, and it is available now. So all you have to do is punch in your email. You'll receive it. It's again 100% free. And if you have feedback, comments, questions, etc., feel free to drop them in the comments or in the chat. on this as well, or just tag Richard and I on Twitter. So I shouldn't say Twitter, I should say X, right? The daily trading routine. So let's start with a little bit of why it's important, right? And that's with everything. You want to question every single element that you have in your trading and why you're doing it and why it should, be done in the first place, so that your mind's convinced that it's a positive towards your end goal of becoming a stage 3 trader. So performing a daily routine is essential because it keeps you in tune with the market action. So if you don't have a daily routine, let's say you only trade Saturday to Saturday, there are things that happen throughout the week where you might have to adjust your weekly plan, right? So that's the first thing it accomplishes. You stay in tune with the market. So let's say you have a plan ready and complete by Saturday evening. You take Sunday off and you go Monday, and market does completely opposite of what you expected it to do. We have some event over the weekend, and now we're gapping down 2 to 3%. You have to go through your daily routine, tweak your weekly plan a little bit as you go from Monday to Tuesday to Wednesday, and so on and so forth, so that you could stay in tune with the market. If you go Saturday to Saturday, things might change a lot. And if you stay on the same course, it might not be the best course of action. That, what you anticipated on Saturday is no longer happening. Second portion builds consistency. So if we want to be professionals at this, we want to get out of stage 1 and 2, and we want to go towards stage 3, we have to build habits. And habits are basically, you give time to whatever profession that you want to excel in, and you're going to get rewarded back for that time, right? So it builds consistency, it builds good habits, and you spend time with the market, you build seat time, you build experience, you think of new things, it allows you to be creative over a span of time, right? And it's part of the process of you evolving and growing over the span of decades to go towards push yourself towards stage 3. So it keeps you focused, helps you execute, keeps you in tune with the market. Identify rotations. So if things change, let's say energy is going up one day and growth is getting hit, you want to be in tune with that. If all your positions are in the growth space, your portfolio is getting hit, well, it's time to adjust, right, at that point, because you could, or you could say rotation is completely out of the markets, where all groups are getting hit, and we're seeing money flow out of the market. That's never a good thing as well. So it helps you identify rotation, and is a daily health check, right? You're checking the health of the market. Hey, are things still going according to plan? Things are not that bad. What's going on? Where am I in my market cycle count? We'll talk about that a lot today. So it keeps you on the right side, even though you put in 2.5 hours on Saturdays. Anything to add, Richard?
Yeah, I'll say with regards to the daily trading routine, just like the weekly routine, it's critical to stay in tune with what's going on. If you feel like when the market opens, things are moving a million miles an hour, you feel overwhelmed, you're not quite sure whether to be aggressive, defensive, what's going on, that's a sign that you have to take a really hard look at both your weekly routine and the daily routine that we'll cover today. With this set, it gives you clarity and peace about what every single day you should be looking at, and it allows you to really focus and kind of ignore everything else. So in the chat right now, I love for you guys to kind of type out one, if you have a routine, and maybe kind of the key points of your daily routine. And if you don't have a daily routine, it should give you, today's webinar should really give you a great idea of a structure, a framework to create your own. So highly recommend it, especially if there's this feeling of, I don't know what to look at. I'm looking at too many stocks, everything's going a million miles an hour. This daily routine is really important for that long-term success. And especially if you work full time. I know we've got a lot of questions about, how can people trade if they work full time? If you work full time, this daily routine is just as important as your weekly routine. You might do it, at 7 p.m. each night, but it's going to keep you in tune and kind of build that awareness about what stocks are moving, how's the market, even if you have, only half an hour to do it at 7 p.m., 8 p.m. at night, after dinner, whatever. So I think, wherever you are in your trading, especially if you're stage 1 and 2, this daily routine is extremely, extremely important, and it will slow the market down and allow you to really focus on what matters and focus on the best opportunities for your system.
Awesome. So key steps, again, we broke it down into first one is probably the biggest one, is you don't want to complicate it where you spend a lot of time on the weekends and then you expect yourself to spend a lot of time. I know more than, 80% of you are probably working full time and you invest and trade in the markets as, as another source of income, right? Because that's your interest, it's your passion. You want to do it full time, eventually get there one day. So you want the process to be efficient. We'll focus on that first. Then the second step, how do you review your positions? How do you rank them? Third is how do you build awareness of what's going on in the markets? A very quick way. What are some quick ways to do that? How do you create a focus list? So even though you might have a weekly focus list coming in, how do you adjust and kind of tweak that on a day-to-day basis? Maybe there will be some weeks where you don't need to tweak, right? Say 5 to 7 names on your focus list that make it from your weekend routine will stay throughout the weekend. You don't need to adjust. But there will be other weeks where kind of things just get scrapped out or thrown out the door and you need to adjust a little bit more than other weeks in the markets. Then how do you build a game plan? What are your if else scenarios? If this happens, then I'll do this. If this when this happens, I'll take profits here, etc. On a daily basis. Then trade execution will go into what does pre-market look like? What does during market look like? What does a first hour look like, right? And then into the close, what are you looking for as well? The last bit is post-market routines. What do you do when the market closes? That should be super, super, super clear and very evident as well. What we're trying to do here is trying to put into words what typical or not typical, I would say successful traders seem to do when they wake up, be it at 5 a.m., 6 a.m., and then when they sleep, right? Or sleep can be, when they just shut off their computers for the day, 8 p.m., 9 p.m. area, right? And we'll try to cover that whole scope so that you could see what they're doing and then pick and choose what works for you, right? Some elements might not, some might be a little too much for how much time you want to spend. All of that comes down to personal preference at the end of the day, but these are some of the best practices that we see people seem to employ. So the first one is efficient process. So having it, the way you want to structure it, you have to have some clarity on what you're going to do as your day begins. So you could take that as an example. Let's say, you work a job and you want to trade, right? That's one of the scenarios. Now, if you wake up, if you're in the corporate culture, how it works is you have a set of meetings, and then you have, in the middle is when you actually do the real work throughout the day. So if you wake up and you visualize, hey, what does my day look like today? How busy am I? What am I, plan? What's the plan for the day? And that increases your efficiency at the end of the day. Now we apply that to trading as well, right? What is the market doing? Let's say you wake up, you check futures, indexes, etc., and you look at the pre-market. And now you that's when your plan begins. But having some sort of efficiency, right? Which will increase your effectiveness of how you execute that routine is basically what your process should be, exhibiting. If your process is excellent and you have a clear goal, hey, I need to do this today. And this applies to everything. It's not just trading, by the way. So if you're planning your day out, well in advance, you're going to get things done a lot quicker. You'll be more productive and you're going based on some discipline you've set forth, some boundaries. As humans, we get distracted. If we don't have a set of things to do, we deviate, and what we actually need to get done never gets done, right? So focus on having a very clear process when it comes to the markets. Hey, the market closes 4, I'm going to take an hour nap or whatever the case might be, right? Or when I get home back from work, I'm going to spend 30 to 45 minutes to get my daily routine done, right? And you dedicate that time, you get it done, and so that you can again build mental capital at the end of the day. So having that clarity is very, very important because it allows you to be passionate, right, about the markets. You spend time with that and you get better over a series of 282, 252 trading sessions a year. And then you step away, and it's the mental capital that builds up that allows you to come back and execute the next day. A lot of traders at stage 1, 2 will sit there, try to figure something out, exhaust themselves. Our brains have limited power at the end of the day, and we need to harness that power and think of the long game, not the I will figure this out in a week. You won't. It's you will figure it out in 5 years, right? So piece that out day to day, make a little bit of progress, step by step, get to that level, and you will get there. A lot of people seem to be in some sort of rush that things have to happen right away. Things have to happen in 3 weeks. I want to learn this. I'm going to execute trades. I want to be the best. It's not that easy, and it takes a little bit of time. So the focus on the long game. It will process excellence. Will basically allow you to really nail this. The best traders that learned in a short span of time, someone like Oliver Kell, as he won the investing championship, he had less than 5 years of experience in the markets, but it was his process, what he saw, and he repeated what he saw successfully again and again that allowed him to see success very, very quickly in a short span of time. So efficiency is key to maintaining a routine. So if we make our routines big, long, too cluttered, we're looking at too many things. It's many of you that are working full time will not be able to keep up. So we want to make them efficient as possible. Look at the right things for our trading style and get them done. Right. So that's why I recommend, up to 1 hour, maximum 1 hour. Now, if I am doing this for a living, yes, I might spend a little bit more time, an hour and a half, 90 minutes, up to 2 hours, because this is all I'm doing all day. But for folks that are stage 1, 2, have a full-time job, you just dedicate 1 hour, have a very clear, hey, these are my steps. I'm going to go through this. These are going to make me better because I'm going to do this 200 times over. And when I do this 200 times over, I'm going to be way ahead in 6 to 8 months. As you take those baby steps, have a visual flow. So this is one of the flows from one of the TraderLion subscribers. We push people to kind of build their daily routines. So he looks at the markets, reviews his portfolio, does a watch list review, runs the scans that he needs to run, builds the focus list, builds market awareness of what's going on, and then he has a clear daily plan. This is at the end of the day, this is your goal, right? And how long is it going to take? Less than an hour, right? It's very easy to do all these steps, run your scans, come up with a focus list. It's most of this is clear as as the market is trading throughout the day. You have a very clear picture. Even if you look at the market end of day, it's perfectly fine. And you come up with these items. Now you're ready for the next day and you go build mental capital. So I'll stop here, Richard, if you have any thing to add or if folks have any questions.
Yeah, what I want to add is that this process, creating daily routine, you're always going to be iterating on it and improving it slowly. Likely you'll be almost simplifying it. A lot of people start with a lot of different steps, and you'll find that that doesn't really help me at all. That just wastes time. It distracts me. It's noise. So don't be afraid to just put something on paper. Start with that. Start simple. Build on that if you need to. Take stuff away if you need to. And your situation might change as well. So you could start a new job. You could move. I personally, I was on the East Coast for a while, and then I moved to the West Coast. So a lot of my daily routine is now very evening focused. That's where I get a lot of the work done, because I just don't have as much time after I wake up in the mornings where I used to do a lot, the bulk of my routine. So it's always going to change. It's going to be in flux, but there's some key things that you should include, and that's kind of what the whole goal of today is to talk about those key steps that you need to take to become a successful trader based on our experience as well as the top traders that we know. But again, just like the weekly routine, the key thing is you start with something, iterate over it, and just like Rai said, if you do your daily routine consistently for a year, you're going to be miles ahead of where you were a year prior. You're going to feel so much more in tune with the market. And I think that's the biggest thing with these routines. If you consistently do your weekly and daily routine, you'll be so surprised about how much you're keying in on the leading stocks, market turns. You'll be right there with everybody. People see the tweets David Ryan puts out, Mark Review puts out, Oliver Kell puts out, and they're amazed about how they saw something and it seems magical and it came true. It's all just because they're very in tune with the market, and are paying attention every single day. And you can be right there with them by setting up a routine and consistently following it and improving it over time.
Awesome. So there's a couple of questions I see in the chat. Can you explain the workflow, elaborate? We will do that. We're going to cover each of these aspects and what's going on here. That's the rest of the webinar, basically. There was another question on, I saw it somewhere, sorry. How do you check for themes and ETFs daily or weekend? We'll get into that. We covered a bit about ETF and themes during the weekend, like the last webinar. So if you want to go watch that, we went into the details of a good way to sort ETFs and catch rotation quickly in that. So let's keep going. So that was this is step one. You want to make sure you don't overclutter, you don't add too many. But I see a lot of people just add a lot of stuff. And, at the end of the day, you have to look at what's the outcome. Am I making progress? Am I not making progress? Right? If you're not making progress, you have to work your way backwards. What's wrong with my weekend routine? What's wrong with my daily routine? What's wrong with my process? What's wrong with my entry setups, tactics, etc. You have to work your way. If you're failing at something and you're not able to improve upon it, then you have to peel back the layers one bit by bit as you go through, what's contributing to these inputs? Am I complicating things too much, right? Am I paying too much attention to what others are doing and not trying to formulate a picture for myself at the end of the day? So all those things kind of play into this. And I really like what Richard said with respect to, it almost sounds magical that people with, 20, 25 years of experience, under their belt, they seem to know what the market's doing. All they're doing is they're doing these daily and weekend routines over a span of a long period of time. Now they have developed some sort of feel for the markets, and it allows that feel allows them to anticipate, a little bit better than 3 or 4 out of 10, closer to 6 to 7 out of 10 in the markets. And, when you come out and say, hey, action underneath the surface is not looking good. What is that? They're scanning the markets, they're reviewing their watch list, they're looking at their portfolios, and they have a good gauge on what the market is, the indexes are doing. It's just as simple as that, as technical and, traders. And then they take the leap. Stage 3 traders take the leap. They say, even though the action looks good right now, there are signs of failure within the setups that I see. I'm anticipating, even though Thursday was an up session, right? Where the market gapped up, things weren't, we were due for a pullback, which happened Thursday, into the close Thursday and Friday, all of Friday, we're due for a strike. So they get a step ahead of the markets. They sell some of their positions into strength. That's the state we want to move towards, right? Bit by bit over a span of time. So step 2 of your daily routine is, a lot of people are very, I would say, they get very eager to go out and look for new trade ideas, especially when you're new, right? Because you want to press that buy button as much as possible. And I think that's the worst thing you could possibly do, especially when starting out. Always start with what you own, right? Take care of the things that you've purchased in the markets. Look at those first before you go out and scan for new ideas to even add more and more to that. So review your current positions. It should take, this exercise is no more than 5 to 10 minutes here, right? You open, if you use IBKR, if you use whatever broker you use, Thinkorswim, you review your current positions. What's acting well? What isn't acting well? Do I need to update my stops? Do I need to raise my stops? What are some of the key levels on my names? Is this thing, my average price is below the 21-day? And if the rising 21-day breaks, what am I going to do, right, on that position? A lot of these things are mental. Stage 1 traders should definitely write these out. Stage 2 traders can move towards more of a mental picture at the end of the day, and stage 3 do this mentally all the time, right? So review current positions, rank them from weakest to strongest, know your stop loss levels. Do you need to update them? How do you ensure a rising equity curve? We've spoken about that in a couple of webinars. What are some of the key levels? Review exposure levels. This is very key. If we're early in the cycle, your exposure should be the highest, right? We've spoken about that in the market cycle count that we covered in previous webinars. But you need to have a handle of what's my exposure, 20%, right, of my total account, 30%. Stage one traders don't measure this. And we spoke about it at length in previous webinars. So always have on a, almost a daily basis, a visual of if everything hit, imagine everything goes to zero tomorrow, right? How much money are you going to lose at the end of the day? So your exposure level should always be relevant and, available and, there for you to, in the back of your head. The third is when you do these things, you're going to prepare mentally or in writing on what, if this happens, if Netflix comes back, in and breaks the rising 21 day, I need to have some sort of action associated with that. Or if the market's going up and this particular name that I said is my weakest position is not performing, right, and is still not acting well, then I need to get rid of this name, right? So if these type of things that you think through as you review your positions, even if you don't plan for this, let's say you don't plan for something, you have 4 positions, you rank them weakest to strongest, you go through this whole exercise, and your strongest position starts acting weak, right? Now, the next day in the back of your head, you're going to build that level of, you'll build intuition, you'll build feel for the markets just by going through this extra. Even if you make the wrong decision and you don't have the if else type of thing planned out, the next day you're going to say, hey, I should have looked at that this way, right? And that's how you will get better. And that's really the meat of the exercise is really this. The byproduct is you'll get better at planning different scenarios over, day to day. So Richard, anything you want to add to, how you maybe go through your positions and what you're looking at when you go through your portfolio daily?
Yeah, I always rank my positions and I've got a mental picture of, I've got a 10% gain on this stock and it looks like it's setting up a higher low. So this is my key level to the downside, but it's acting normally. But this position I just bought 2 days ago, I've only got a 3% gain on it. It had a poor closing range yesterday, so mentally, I have to watch that one a little bit more carefully. There's stocks that are just doing their thing. You've got a profit cushion already. You've already maybe taken some off that you're just letting them trend above the moving averages. And then there's stocks that you have to watch a little bit more closely because you don't quite have that freedom of a profit cushion just yet. So yeah, I always rank my positions and sort them mentally. These ones I can kind of let them do their thing. These ones, I have to monitor a little bit more, especially if the market pulls in a little bit harder. So yeah, I think it's really important. And just to reemphasize the if then process, you really should have this for every single one of your positions, especially if you're stage one, almost written down where, if we break the 21 EMA, I'm a sell half. If we break below the base pivot, I'll sell another quarter. All those steps should be really planned out. And then as you gain experience, as you become more stage 2, stage 3, then it's more of that mental process of, oh, it's normal action versus abnormal action. And you can be a little bit more free flowing with that.
Also, another way to do the if then is just setting alerts at key levels, right?
Yeah.
And then place a note on that alert and say, hey, when I receive this alert, why have I placed it in the first place? And then write a mental, hey, I mean, maybe I need to sell 1/4 of whatever you get alerted on, or sell a half, or increase or add to this position if it goes above this level, etc. So alerts are also a really good way to accomplish this. So third is, how do you build market awareness or situational awareness? How do you go through some of the steps to say, hey, the market's acting fine, or hey, the market is no longer doing what is considered an uptrend in my system, and what do I need to do to kind of adjust those actions that I'm going to take tomorrow. So first is review the markets, right? Whatever your system, however you define your trends, could be the 10-day, 21-day, 65 EMA, 200-day, doesn't matter. If we've spoken about this a lot, is the market in an uptrend, downtrend, and choppy, right? And you want to review that as quickly as possible, not go through all the going through the components and of the QQQ, S&P, or Russell. That's kind of a weekend routine. On a daily basis. This whole webinar is focused on the daily routine. How do you quickly assess the breadth and health and breadth of the market? You look at the trend, right? You can review the market. Or some people have scans, like Ross will go through his up on volume scan. It will tell him the entire story of the market, where rotation's happening, which stocks are acting well, and he uses that one scan to literally paint a picture on a day-to-day basis from Monday to Friday, right? And then on Saturday, he does a little bit more in depth. He goes through IPOs, etc., different scans that he has to paint the full picture. Second is, where are we in the market cycle count, right? Are we anticipating a stress test, right? So this past week, when we had our TML talk session on Thursday for private access subscribers, basically we said we are anticipating that we're going to have a stress test because we've rallied up quite fast and a lot, and our expectation, hey, we might gap up into the 50-day and then fade, or we might go sideways and then pull back a little bit, but our expectation was that we're going to get one. That's just through daily routine, right? Risk reward is skewed. I don't see any setups in the short term. We need a little bit of consolidation, pivot building again on the top side. That will happen when risk reward is good. Market's going to try to attempt to go even higher. So have that as part of your market cycle count. We've spoken about, if any of these concepts seem foreign to you right now, we've spoken about each of these in the previous webinars in great detail and full examples. So be sure to watch those as well. Second is progressive exposure or risk management day. So you can define, I would say, different days in the markets. You can define, hey, when you do your daily routine and you're complete, I usually have a clear picture of, I have 3 positions on, I have X amount of exposure. I think this is a good level of exposure to have. Tomorrow is a day for me to just watch and see what happens, right? Watch my positions. I'm not interested in, and I'm not going to go buy new positions out there because I feel like I'm in a good spot. I just need to sit and watch as to what the market's doing. This concept alone is very, very powerful in terms of how it could help you and move you from being trigger happy, right? Stage 1, 2 traders, they want to wake up, something's moving, swipe right, feel excited, get that, the rush, and now you're in the game and the market's moving fast and now you're down on the position, all of that. You have to slow that down, right? The best players, when they're playing basketball, they say the game has slowed down for me. The best baseball players say the same thing. They see the ball as, a beach ball coming at them instead of a baseball. So how do we slow things down for us in the markets? We could say, after I do my daily routine, what kind of day is it going to be for me tomorrow? Am I looking to increase exposure, right? And then I'm focused on entry tactics and I have my focus list of something triggers. I go in on that and act. Most of the days will be risk management days, right? I would say like 60% of the days, or maybe even 70% of your days in the markets will be, you're just watching your positions. And execution is very small part, or progressive exposure, or that initial exposure you put on as the market cycle count turns positive or negative, are those first initial 1 to 3 days. Then you're just watching, right? How long is the market going to keep me in? Is this market cycle count going to be 20 to 30 to 50 days, right? Or we're going to have a 2 to 3 day upcycle and we're in a choppy phase, right? In our trend, we're going in, putting on exposure, but the market is kicking us back out. And this alone, you keep track of this, it will help you get to stage 3 a lot quicker at the end of the day. Third is, are we gapping up or gapping down, right? Let's say you planned everything. It's evening time. Futures are flat. Everything's perfectly fine. You wake up and you're waking up to a 1.5% gap in the futures. You're waking up where you planned an entry at 48.50. The stock's gapping up at 51. What do you do? right? You need to have a plan. You can't say, okay, risk management's out the door today. We're gapping up. Everybody's happy. Let's go buy at 51, even though my plan was 40 at 50. That's never going to work out in the long term, right? So there are times where you will be in sync with the markets. You're doing well. You're doing, you can't mess up basically. And there will be times in the market where nothing that you do works. It's just that the market is not in line with your system at the end of the day. So have a plan. If a gap up's happening, just have a rule, right? If something's above my planned entry, there are going to be so many market cycles. It's just that you need to survive to see those market cycles at the end of the day, right? If you're not there to trade them and you go chase a gap up and things are fading as they don't normally should, and now you blame the markets and the news and this and that, that's not going to do you any good at the end of the day. So the last bit is how aggressive I should be. And this, I think the last point goes into, is it a progressive exposure type of day? Or is it a risk management type of day? If you define that for yourself, you will have a lot of time to just watch and see. The best traders most of the time are just watching and seeing what the market does. They're watching from the sidelines and assessing the conditions. That's 80 to 90% of the time. They're just assessing the conditions. And when they feel it's right, it's a progressive exposure day for them where they know that risk on is about to happen. That's when they're concentrating on execution, right? But most of the time, they're just managing my risk. I'm watching what the market's doing. I'm assessing the conditions, and that's all I really need to do, 60, 70, 80% of the time. I think the better trader you are, the higher that number is. It's closer to, 80, 85, 90%. They're just watching, seeing what the market is doing more so than, every day trading some stock to get some feedback or get that, excitement in them day to day. So, Richard, anything to add on how you review it?
Yeah, no, this is pretty much what I do. What I want to add is with regards to risk management days and when is that window where you want to put on positions. I think a lot of beginning traders almost do the opposite, which makes sense of the experienced traders, where there's a start of a market cycle. They weren't quite ready because they hadn't been doing the routines. They're waiting for confirmation where the market's up a few days, and then they start putting on positions. But at that time, breadth has already expanded. Stocks have already made significant moves, and we're in that area where a stress test can happen. And what happens? They get stopped out of those positions. It takes a hit to their psyche, all of that. And then after that first stress test, if the market holds up, there's another window where you can put on more positions as pivots form, ranges form, and the market kind of reconfirms upwards. So the key thing with these routines that we're trying to get across is be in sync, so you know when that point is where reward is worth the risk. And when it comes to the risk management days, when the market's already extended and far, and the leaders have already run, and we're expecting a stress test, just be aware of that and know to take a seat, wait for the action, wait for pivots to form where stocks are coming back in and they're setting up again for your system. So yeah, don't be too eager. Know when you want to put on exposure, and know when it's best to just kind of sit, wait, and let the market kind of figure itself out before it sets up another kind of opportunity window. Yeah, so that's kind of a line, but I think that's a key differentiator that I've noticed between performing traders and then also stage 1 and 2 traders is, how aggressive are they early when, it might feel more risky, but you're able to manage risk tighter and you're immediately at a profit if breadth expands and the market cycle really, really kicks in.
Perfect. So the second step is you want to review. So once you've reviewed the markets and you have a good handle on what the market trend is uptrend, downtrend, etc. The next is you want to key in on stocks, right? How are they acting? What you've defined as what we talked about as potential leadership groups, how are they acting? And then the most important, I think, how are you performing, right, over the last 5 trades? So those 3 things, if you're in tune with those, hey, on the weekends I said the semis are one of the top groups, or software is one of the top groups, or uranium is one of the top groups, or gold miners, right? Is that still the case? You should have a very quick way of seeing that, visualizing that, no more than 2 to 3 minutes of, seeing it. If you maintain a focus list, right, you go through your focus list, or you maintain a universe list of, let's say, 50 names, 60 names, quickly, space bar through them, see the different charts. Hey, things still look fine. Most of the days will be like that. Friday is a little bit, this past Friday was a little bit different. Things have pulled back in. Now, some things might change, and that will be part of your weekend routine as you go in, take a deeper dive into what stocks are doing, why they're doing, why do we have a, kind of a more than anticipated pullback, or it's still within means, right? Depending on how you look at the market. So, reviewing those key stocks and leaderships, and this is something Ross is very big on, Ross Haber. Uh, he 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 always gauges leadership first, right? He says most of the time, as we had this pullback in September and then the subsequent rally, his message was consistent. I still see enough setups. I still see enough leadership for the market to hold its shape and attempt a rally. And then we eventually got that, in the early part of October. Now this past, Thursday, Friday, we've pulled back in. Now we'll see from there. So he's always looking at those leaderships. He said, it's the only thing he does. He doesn't look at, I would say, stocks above 200 day. It doesn't matter to him whatsoever. He goes through individual stocks and says, are leadership stocks acting well? Do I have enough to work with? Do I have a basket to work with, or I don't? If I don't, that means stocks above 40 MA, 50 MA, 200 doesn't matter to him. He has his own way of kind of quantifying or, looking at the markets that way. So, me personally, what I tend to do is I go through my focus list. That's most important because these are the names I pick to be the best performers if it's an uptrend, right, for that week. How are those names acting? If they're acting well still while the market's pulling back, then I'm pretty bullish, right? I'll bank on that because that's part of my process and routine. If the market's doing good and those names are not acting well, I'm kind of taken out by the market. Market's saying whatever you whatever you chose in your weekend routine is not performing well. So then I'm sidelined, right? The market's giving me that message. I go through my universe. So universe is all of my, my HTF watch list, my IPO watch list, and my high volume gap watch list. I go through all those names. It's, 50 to 60 names, at times, maybe 100 names. Takes me no more than 5 minutes to just review those stocks, see what they're doing. Is the pullback widespread, or is the strength narrowed down to a certain group? How are things in correlation with the markets? That's the second layer, right? The top down approach that we spoke about. You review markets, then you get to stocks. You could do the other way too. You review stocks and leadership, right? And then you go review the markets to see what they're doing. So both ways work. We've spoken about that in previous webinars. Richard, I'm curious to see, how you go about reviewing your key stocks and how do you keep track of kind of the common themes and leadership names?
Yeah, so I have a list that I put the stocks in that cycle that I deem to be leaders. And then in the morning, I look at that list and I look at my weekly focus list. Often there's a lot of overlap because I'm trying to focus on the leaders that are setting up. But in pre-market, that gives you almost immediate feedback. You see, hey, the software names on the leaders list are all gapping up together on above average pre-market volume. The oil leaders are pulling back today. Oh, they're acting well today. That helps you identify the themes if you're taking a look at that stuff. So somebody asked, is identifying setups part of the market awareness, situational awareness, or is that something separate? It's all related because the number of setups, like we said, is an indicator of the overall market health. I look at the market indexes, the leadership stocks like we're talking about today, as well as, how many strong A plus setups can I put on my focus list this week? Everything is boiled down and combined together to give us this situational awareness. That's the whole part of this step, is to combine all these different factors that you should be looking at and into kind of one situational awareness statement, which I think we'll get to on the next slide. But the last point here, how have my last 5 trades performed? How have my last 3 trades performed? I think that's really key as well. In the beginning of a market cycle, if you're getting positive confirmation, you can try another setup. But if you put on 5 trades, every single one stops you out, you should really listen to that feedback, size down temporarily, and just wait to see if setups that you would have taken start working, and then you can start putting on things again. So listen to everything, listen to the stocks, trades, and the leadership to help inform you about do I want to be aggressive today, or sit back and wait for things to set up how I need them to set up.
And we'll go over an example of what happened Friday and how, I placed the trade and got instant feedback as to keep away, right? Stay away basically. So we'll go and when we get to the trade execution part of that. So the next is, once you've done all of those things, what I tend to do every morning is basically, what type of day is it for me? I'm very clear on that, and I try to voice it. I try to write it down so that I can stop myself from kind of acting out of line, right? It's very easy, especially when I was starting out, and even now, if I don't do this, to go in with a plan and then the plan goes out the window because I feel some sort of FOMO. I feel other traders are doing this. I feel, this X person that I follow on Twitter has said this, and now my own convictions, my own homework that I've done, I have no confidence in anymore. So I kind of do this on a daily basis. Basically, I define, like we said, what type of day is it for me. So this is the market cycle count. So whatever system you have, it could be above the 21 day, etc. Doesn't matter. So it's day plus 3. I'm looking to establish some positioning in strong names. So I'm going in saying that this is a day I need to continue to increase my exposure because it's only day 3 of this new uptrend or this new market cycle, right? The second is, what's the market doing? Is it choppy? Is it good enough for me to put a position on, etc.? So I define what kind of trend we're in overall, right? Is it still, it's choppy, but we might change to an uptrend. If it's choppy, we might, stay in this choppiness for a while. What are my thoughts, basically? So I can look back, right? If I, now this is looking back at May 9. This is very early at the start of the upcycle this year, where we got a whole bunch of things yapping up, and the market really flipped the switch on, right? A lot of things rallied from May. So, and then just writing your thoughts down. So most of the times your thoughts won't change day to day. Like a Tuesday to a Wednesday, the market closes flat, your positions are fine. You won't have much to say on the next day, but it's a good exercise to keep over a span of time, because you can go look back. Hey, what are my thoughts on May 9? What were my thoughts on May 10? How did I look at the markets? What did the markets end up doing eventually as well? So market cycle goals for today, any key news events. So if we're gapping up or gapping down, I'll kind of include that. Aggressive, it's a day for me to be aggressive. Do I just sit on the sidelines and watch? Is it just I'm managing my risk on my existing positions because we're anticipating a pullback? I'd rather focus on what I have than go out and buy new positions, right? That alone will save you a whole bunch of money in the markets at the end of the day. And then what could the market tell you, do today, and how will you respond? That goes back to, your position review that you do, right? If the market does this, then I'm going to do that. Then my actions will be listed. So I think, just having this, I still think this is probably the most important point here, is if you define the type of days for yourself based on the homework that you've done, you will stop yourself from yourself, because then you won't switch to all of a sudden you said it's a risk management day and now you're putting on, and you ended up buying 3 positions. A lot of you traders that are watching this now do that. I know for a fact because I used to do it. I know for a fact because I've watched others do it as well. Yes, you can all of a sudden change your plans, but in the heat of the moment when the market's open and your emotions naturally are elevated when the things are moving up and down and you see price moving up and down, And then this day and age where you have this, the phones and social media and, 1,000 opinions coming at you, it's very easy to deviate and go some different route because you're now listening to someone instead of actually doing the work for yourself and acting on that work that you did. So, um, Richard, your thoughts?
Yeah, just I also with the key news events, there's some market impacting news that can happen during the day, like Fed meetings, minutes, that type of thing.
Yeah.
Uh, also, it's important, season is coming up. Be aware that, earnings report of one of the big cap name stocks, if it's before the market or it was after the market the day before, that's going to impact things. Just think about what can move the market. What's the market paying attention to? For a while, CPI was the big thing, can be jobs numbers. Think about what's impacted the market recently, and if some news event is coming out with that, pay attention. So just bringing it all together real quickly, how do you write this condensed kind of situational awareness note to yourself? Establish a market cycle. We talked about creating one. You're using the 21 EMA 2 webinars ago. Take a look at your focus list. How are they performing in pre-market? How are they performing overall? Take a look at your leadership list. How are they doing? Are they, gapping up, trending nicely, extended to the downside, what have you? And then take that information and condense it into overall market thoughts. Just jot down how you're feeling and your overall thoughts. And like we said, if you do this for 200 days, you'll be astounded at how your notes change over time. And you'll go back and read one that you posted 3 months earlier, and you'll be like, wow, I didn't recognize this at this point, but now I've got this clarity because now I've noticed this trend. I'm connecting this state to something in the past. But if you don't do this, if you don't take these notes, you'll never know that, and you'll never consistently kind of iterate and improve on this process. So this is really key, being aware of the market environment, if you should be aggressive or not. It's a huge part of successful trading, and knowing when to take trades, knowing when the odds are kind of against you. Everything comes back to kind of the situational awareness. So it's really important.
Awesome. So step 4 is now, the first, just to recap, step 1, review the markets. Step 2, review your positions. Step 3, build a market and situational awareness post, right? That sums up a lot of the other steps. Now, step 4, let's talk about how do you create a daily focus list. So all of this starts, I'm a big believer in, when I started out, what I would do is market would open and then I would start scanning, and I thought, I could get away with it basically executing while the market's open, right? So basically treated it like you do a corporate job, 9:30 to 5 type of thing, or 9:30 to 4. And that is not going to work unless your thing is day trading, right? And day trading is very, very hard. So with swing trading and position trading, a lot of it happens offline when the market's closed. So you want to start, in the prior evening, you review your focus list, your universe list, your leaders list, environment dependent scans and screens. We'll get to all of this in a little bit. The main criteria here is if your watch list is more than 5 to 7 names, and you're calling it a focus list, it's not a focus list, it's a watch list at that point. So you want to restrict yourself somehow, some way, have a criteria, figure out a way to box yourself into those 5 names or 7 names when the market's opening. So sometimes my focus list gets a little bit bigger, closer to 7, 8 names. At that point, the market might be really, really good, right? Or sometimes I tend to include my existing positions that I will add on to, maybe 10, I already have a 15% position. I want to increase it to 18%. So I'll add that name to my focus list as well. In those instances, it's fine to push that to the 7 to 8. Most of the time, just try, as you build your scanning routines, your daily routines, try to get towards 5, because when the market opens, execution matters, and you can't watch 15, 20, 25 names Some people go crazy, set 400 alerts. I don't know how they do it, but that's just, for me, it's ridiculous at that point. So try to get closer to those five as much as possible. Now, how do you do it? How do you rank them, etc.? We'll get into a little bit later. But the point I'm trying to make here is if you're watching too many, you won't get any. Basically, that's the name of the game. You're watching 15 names, you're not going to get any of them because you're going to be cross-eyed by the time things are moving, emotions are high, DCRs are moving up and down. You don't know which sector is moving. You have no idea, and you're making it worse for yourself. You only have two eyes, so work with those and try to just manage five names. The most actionable, highest quality setups and opportunities. So it's very easy for us to say this, right? Very easy just to say, hey, just trade the best stocks. Like, what the heck? But it's very hard to build your processes to get to those highest quality names. Your daily routine as you go through this whole exercise that we're covering right now will allow you to hone in on this skill, right? How do traders anticipate and say, place that really specific name on their watch list because it meets their setup and entry tactic criteria? They can anticipate that the breath is about to go positive in the markets. The market's about to flip the switch. How do you place that name on there? As you go through your daily routines 252 times a year, you will find ways and see patterns and say, hey, I looked at APP on this gap and I tracked the name, but I never placed it on my focuses back when in June. And now it's rallied up that much. Why is it happening? Then you work your way backwards, right? Like we spoke about in the last webinar as well. The whole idea is repetition of that. Missing stuff is a good thing. You continuously miss setups, you continuously miss stocks, but then you learn from each of them. And then over a span of time, you'll create a kick-ass watch list for yourself to trade upon. So
Can I add something?
It's 1 o'clock. Yes.
So yeah, 5 to 7 aims max. I like to keep it, almost 5 max, just because I found I focus personally better on that. You might be able to keep track of 8 stocks and track what's moving, what have you, but the less stocks that you're focusing on in the morning at 9:30 when you're ready to execute, the better you're prepared you're going to be. You're going to know your plan with every single one of those stocks, down pat. You can have the orders pre-made in your broker ready to execute. You'll just be able to get better buy points with lower risk if you're looking at less stocks. And restricting yourself to 5-7 names, it does mean you're going to miss opportunities like Rai said, where a stock that was in your universe goes without you. That's fine. It's better to execute well on 4 stocks than have 15 stocks on your focus list that successfully went, but they went without you because you weren't able to manage risk because you were trying to keep track of too many things. So it's not an ego thing of always being able to pick the best stocks to have on your focus list. It's about actually making money with the stocks that you do have on your focus list. And to do that better, to get better buy points while managing risk tighter, the less is more. So it doesn't matter if you miss stocks, you'll be able to pick it up on the next buy point or in the next market cycle or what have you. Focus on a few and execute really well. And that's for me what I found really helps. Helps me capture moves and get in with low risk at a spot where I'm expecting a large directional move. So I think less is more with this daily focus list. I have kind of usually around 15 stocks on my weekly watch list, and then every day I'm looking at what are the most ready, what are the tightest, what are the ones right near a buy point, and I'm putting those top 4, top 5 names, right smack dab in the middle of my screen, setting alerts, before the pivot, so I'm ready to go with those specific names. If another stock on my focus list, goes without me, that's fine. I'll look back at the end of the day, end of the week. Why didn't I choose that one to put on my daily focus list that day? What should I look for in the future? But, I don't feel bad that I missed that. I'm glad that I got it, a step, it was on deck. It was on my weekly watch list, but then I have to figure out how do I make sure that one's on my daily focus list. I think that's really key.
Yep. So if you miss it, you could study it basically,
yeah.
right? It's always a positive. Always have a positive frame of mind, regardless of if you miss all, if you have 5 focus list names and you miss all 5, you at least you had them on that list to begin with. So it's still a positive, in my opinion. The second thing is, like, how many of you owned NVIDIA, ELF, CellH, ABB, VRT, some of these names that have moved, right? All we really need at the end of the day is to establish really good positions in a very few names, and then move towards concentrating on those positions, because that's at the end of the day, that's what you want to be in, right? PLTR moved 100% from 10 to 20. Did you catch it? You didn't. So what's the point of having, 15 names on your watch list when you can't catch the top 5? At least have one of the 5, or at least have one of the 8, right? If you catch the NVIDIA and you're holding from May to now, that's 100% plus gain. If you have VRT, right, it's on its third gap up and it's moved 80% from May. You have that ELF as it turned and built out that weekly base, and we covered that in previous one. So focus on having that type of mindset and say, hey, I need only kind of 1 to 3 names per trend that will really drive my portfolio to the upside, and I don't need to crowd my watch list with a lot of names and then catch none of them at the end of the day. So that mind, a lot of traders, a lot of portfolio managers, a lot of people that see success in the markets, they move closer and closer to this 5 name type of mark, because they can manage those. They've really done their homework on them, and they know those names best. They've done everything you possibly could to track them, and now they've come up with this list. And even if they strike 1 out of 5, which might sound crazy to some of you, it's usually that one name that will go and make a lot of progress for you, while then you use the other positions and the other capital to chip away at those gains, right? And then you eventually stop. And so foster that mindset. It will help you in the long run, instead of, hey, I don't want to miss this, I don't want to miss that. 100% guaranteed, no matter who you are, you will miss at least 40, 50, 60% of the top leaders, but you want to focus on catching maybe 2 out of the 10 that are in the top 10 every year. So step 5, once we've built our focus list for the day, we just gave you some parameters. We're trying to emphasize the fact that quality matters over quantity when it comes to building a daily focus list. The next is, how do you build your game plan for the day? So kind of comes down to, it's very similar to your position review, right? How aggressive do you plan to be? For each daily focus list, especially stage 1, 2 traders, tie it back to entry tactics, edges, and then how that correlates with position size, and then what's your risk level, and where are you going to place your stop losses, right? So each position in your portfolio must have some sort of, hey, this thing, you can't marry a position and say, now it's up 25, 30%, and I'm going to round trip. A lot of traders tend to do the right thing, right? In our TML talk session we had this past Thursday, a lot of people were, I'm up on my positions. What do I do? You go and look back at what you've accomplished over the past month. Are you making any progress? And you're up 15% in 2 days on this position. What else do you want, right? They turn into these philosophers all of a sudden, and these fundamentalists out of nowhere, when the initial plan of action was, hey, I have a pivot. It goes through that. I'm up 15% in 2 to 3 sessions on this position. Sell some, make some progress, scale out. Those things, profit taking is not a dirty word, is what Stan Weinstein said about 1,000 times in Stage Analysis Masterclass. Take that off. You'll feel better about yourself. You'll feel like, hey, I'm making, my effort's paying off. I'm making progress. So that is all part of your game plan. As the stage 1 traders are usually in the wrong bucket of stocks. Stage 2 traders figure out that they're in the right bucket. Now they're boom bust, but they almost have this attachment to their positions all of a sudden. And, Cell H is an energy, drink that is going to do this, and Monster ran 900%. Now, all of a sudden, you've formulated yourself a picture to round trip CELH out of nowhere. When your initial plan was, I'm going to manage risk, If the 21-day gets above my average price, it's rising and it breaks that 21-day, hey, I'm out because I'm a swing trader, right? If you're a fundamentalist, you go in, you look at ROE, ROA, margins, gross profit, etc. Then you trade that way. That's perfectly fine to do that. But don't turn, as a position swing trader, I see a lot of traders just turn into these fundamentalists, and all of a sudden they're looking at, numbers that they have no idea, no clue about, what they're going to do. And it's not part of their game plan. They lack a game plan at the end of the day. They don't have a clear way of saying, if I do this for 5 positions in a row and I have 3 winning trades, I'm going to be up 8% on my account. You should know those, and that's part of your game plan. You don't deviate from. Yes, you're going to sell some winners early. You're going to sell some losers too late. Those are part of the things that you're just trying to see consistency in your game plan, right? And then you'll improve. Let's say you sell, you buy a stock at 48, you sell it at 52, and the stock goes to 60. You'll learn from it, right? Yes, you did the right thing. You made a little bit of progress. You followed your game plan. Your game plan wasn't the best. Now you come back and improve that over a span of time. What we spoke about in our last webinar too is a trade is not bad based on profit loss. It's bad when you don't follow or have a game plan you follow for that trade, right? So if I'll go over a trade I made on Friday, I followed my game plan. I lost money on it. I think it was a perfect trade. I would take that every single day, even if I kind of knew in the back of my head it's not going to work. I would still take that because my position size was right. I wanted to get some information from the market test. Is this stress test going to stop midday, or is it completely, going to, keep going lower? That trade gave me information. I followed my game plan for it. I had I had my plan ready. Market was open. The stock pulled back into my level. I bought, at 8% position, had a very tight, 2% stop on it. I got stopped out within 10 minutes. Hey, the market said, not yet. I go back to the sidelines, right? So have those things there. That's going to turn the ones to twos and twos to threes, basically stage one traders to 2 and 2 to 3 at the end of the day. I just, for some reason, some odd reason, people seem to change their plans based on some creative reasoning along the way that eventually hurts them at the end of the day, right? Because it's randomness. So, Richard, I'm curious as to like how you're game planning when you go into a session. Let's say you're put in a bad spot and you haven't planned for it at the end of it. Let's say you have a position and the stock gap's down 10% on you. What are you doing at that point? What are some of the if then? Maybe we could cover those scenarios as well.
Yeah, I've had to deal with some gap downs, as you know. Um, yeah, the number one thing I'm thinking about in that instance of something that I'm not prepared for, like a large gap down, the number one thing I'm thinking about is just how do I protect the majority of my capital. The stock with a large gap down, that's a clear expectation breaker. Um, my focus is to manage risk in the moment. It could rally, right? It could fill that gap or whatever, but you don't know that in the moment. It could also continue to fall down another 10%. So I prefer to be out wanting to be in than in wanting to be out. So that's kind of my focus, is just protect my capital as much as I can, even if it's a 7% loss, 8% loss, because I wasn't prepared, way more than, I'd want. But, I've still protected 93% of my capital. I've lived to see another day, another market cycle, as you mentioned. So in pre-market, I'll kind of see that gap down. I'll think it through. All right, I'll sell half right off the bat. I'll watch with the remainder for 3 minutes. If it continues to move down, I'll sell that last half. I'll set a plan in pre-market and follow that. So I think that's the key thing. Plan as much as you can pre-market, both your entries, exits, and especially how much you're willing to risk on any one trade.
Perfect. I'm curious to know how many people have kind of a like over a span of time you deal with different situations, right? Like a situation like gap down, or you own a biotech stock, or some people say, hey, I'll never trade biotechs. That's perfectly fine. But over a span of time, you want to have some of these scenarios built in, right? So that yes, it's part of like this is how I manage my business. If this happens and this contingency kind of hits, right, then this is my plan for it. Most traders do it mentally. I think it's perfectly fine to do it mentally. But then I see the opposite where traders just don't, they'll gap down. A position's just put them in a very bad spot and they refuse to sell it because all of a sudden they think, they will get out of it and there's really no way out of it. So I think it's key to have those, very dire situations that the market can put you in, like CRDO that happened. Looked perfect. Everything was fine think, above the 10-day IPO stock. The base was good. Everything looked fine. And then all of a sudden, there's a contract that is dropped, and now you're in a bad spot. The next day, you're thinking, hey, I need to get rid of this because I'm thinking series of trades. I lost 2R, 5R on this trade. I've given back a whole bunch of progress on this name. But think series of trades, right? You'll get it back if you survive because that name went gap down and stayed down and went another 40% from there. So if you continue holding it, now you become an investor all of a sudden. So as position traders and swing traders don't turn into investors, I think that's key. You take a loss, you have to take it, take it and move on. Take it and move on. If it's part of your plan, you planned it, hey, this is going to happen, etc. All power to you, but most position traders and swing traders that especially in stage one do not plan. They turn into investors and they say, hey, only 15% of my capital is in this. I will just stash this away and ignore it. But at the end of the day, it's going to work your psyche in a negative way and it's going to hurt your performance as well. So let's go to trade execution. I think this is a fun part of this. We're starting with, I guess, pre-market screens. To run a little bit. So I tend to run, I'm looking at pre-market gap ups, especially for earnings reports. I'm looking at also a little bit of news-based events as well. It doesn't have to be earnings. What are things gapping up on, right? Let's say a Microsoft buys out Activision, right? That was one of the news events that came out. How is that going to impact this space? And, is there going to be a sympathy play or that type of trading? So there's these situations you come up with, or was there a cyber attack that is now taken up all the cyber stocks are going up today, right? Is that a theme coming into the session? Or some stock in the software space reported really good earnings and it's pulling up everybody else up, right? NVIDIA is gapping up. Now all the semis are going with it. So those are some of the scenarios that I tend to look at pre-market. For me, it's very quick. It's nothing fancy, I would say. It takes me no more than 15 minutes to get a hold of what's going on. If our futures up and down, are which stocks are kind of gapping up? Are there any themes within that? And what are they doing? But it doesn't in my plan, it doesn't kind of I'm not going to change the stocks that I'm watching just to stop. Maybe there's an amazing gap up or some stock that reported pre-market or post-market. I will add that to my focus list. But that's still very rare for me because I tend to look at day two gap ups as well, especially earnings reports. Richard, what are you looking at pre-market in terms of news events, etc., screens as well?
Yeah, I look for gaps. Mostly, I sort my weekly lists by volume buzz or volume run rates. The DV universe as well. I'll look for what's moving on that. But mostly, I've done a lot of the work the night before, and just seeing if there's anything crazy going on. Earnings, if there's any stock I was particularly interested in that reported that morning, I'll take a look at that. But for me, just because I have very limited time in the morning before the market opens, I've done most of my work the night before. I've done my screening, and I've kind of already created a draft focus list. So I just kind of have to maybe kick one stock out, put another stock in the morning. But yeah, gap ups definitely important, especially around earnings. And if there's any kind of key catalyst going on, that's kind of what I take a look at.
Yeah, I see a good question. If you're screening pre-market, then do you tweak your daily focus list, basically, right? It's very rare for me to do that unless I see something like the last time I did that was like pins in 2019 when it had hit its initial gap up on earnings. It built a base right above 20, and that one gapped up. I was tracking that name for quite a while, and then when it market opened, I kind of put that on my focus list, right? Because the volume was super high, everything kind of checked off, and I wanted to play day one on that. Um, but most of the time, now I know news event, event-based traders they heavily scan pre-market. So at the end of the day, it boils down to your style. I like to trade day two on gap ups and all of these things. So I'll keep a track of them. Maybe I'll stash them in a separate list and then add them into my main list post market. But for me, it's just I just want to see what's going on in terms. Are there any themes? Are there any particular groups? Is there any news being kind of driving the narrative for the day? But this is no more than like 3 to 5 minutes. I'll know what's going on here. So let's focus on trade execution, kind of, um, so let's start with stay on this with pre-market. I'll share what I'm doing. So I hope that's helpful. So I basically wake up 5:30. I take a look at futures right away, pretty much on my phone, just to get a gauge of, hey, what's going on? Are we, most of the times in a good market, uptrending market, futures don't really matter. In a downtrending market, they do quite a bit because you could have an oversold rally, you could have a giant gap that's going to get sold into, depending on the situation. Next is I do get a workout in, so like, because that helps my brain and my decision making quite a bit. Um, and I think that's important as well, because I believe this is you're getting paid to make decisions, not to sit here and like burn your brain at the desk. So after that, I come in, I look at my stocks that I have in my portfolio. That's my next biggest like priority is how are those acting? Is there any news related to my stocks that I own? What you own is more important than what you're going to buy. A lot of traders get it twisted. So are those okay? They're, everything's still fine. Next step is focus list. I've built my focus list the night before. Do I need to tweak it? I had a name on my focus list. It's now down quite a bit. Do I need to even look at it anymore? Quick, 5 to 10 minute go through those names. If there is news related, whatever, take a look at them. Has anything changed from that perspective? And then from there, I now have kind of a full picture of what um, I'm doing. I've reviewed the futures. I've reviewed my existing positions. I've reviewed my focus list. I've gotten a workout in, sweated it a little bit. So that's good. Now I'm ready to make decisions that, I'm following all of that plus my evening, prior that I follow my routine. So that's what I'm doing. And I just do that again and again. There might be some days where, let's say I'm in a cash position and I don't anticipate the market doing much today. And I'll just skip the whole day, right? I am not going to look at the markets or I'm on a bad streak. So this profession is not about when you can't for the life of you do something right, you just have to step away. So you take time off, right? It's not like nobody's chained you to your laptop and said you have to be here at 9:30. That's a positive of it as well. So there will be those days where you're not looking and you're not doing anything with the markets. You just let the market be. A lot of 2022, if you caught the initial downtrend, right, we're in a 60-day negative cycle, which we covered in our market cycle count. Now you remain short. You're kind of, then you're engaged. You're looking at the market. But for me, it was, hey, the market's still bad. I've taken a look at it the evening prior. I don't, for me, it's a rest day, right? Not a risk management day, not a progressive exposure day. I'm just looking at the markets from the sidelines. Maybe end of day, I'll take a look at it again. So those are some of the ways I go about my pre-market. Richard, if you want to add to how you or what you're doing pre-market.
Yeah, I mentioned a lot of it already, but yeah, when I first wake up, I take a sneak peek at the futures, how they're doing. Then I open up DeepView, take a look at my holdings, first of all, just like you. Then I navigate to the daily focus list that I had drafted the night before. How are those acting? Anything that's gapped up super big and won't really be actionable, or gapped down and won't be actionable, I'll kick that out. Then I open it up to my weekly list, anything that I should really add to my focus list that I hadn't considered before. And then I just do a few sorts and screens on the DV universe and that. But like I said, a lot of my work is done the day prior, where I've run screens for gaps. I've reviewed every stock in the DV universe. So I'm pretty much ready to go that morning, just with a quick check of my positions as well as my daily focus list. And then I'm just ready for the open. When I was on the East Coast, I would do a lot more stuff in the morning versus now I've got half an hour between when I wake up to the open. So I have to be a lot more efficient and a lot more prepared going into that day.
Yeah. So let's cover, I guess, the next thing, market opens. What are you doing? How do you gauge your actions? Like real time, basically your trade execution, 9:30, at first hour, hour and a half, etc. Right. So um, I'll kind of share what I do. My focus on the open is it depends on what kind of day it is. If I have positions on and we're gapping down, right? I'm gonna watch my positions. At that point, there's no point watching my focus list because I need to manage what I have first, right? Take care of those and see if there's opportunity that exists there, or I need to take those positions off, etc. If it's a gap down situation, right? So that could be one thing I'm doing in a particular environment or a situation that the market's put me in. And another thing is the market cycle count has turned positive. I'm focused on my focus list. I have 5 to 7 names that I've come up with. I've done my homework and I'm focused on those names and the price action of those because I know my pivots, I know my entry tactics, I know the edges at play. All of that is done in the evening and I'm ready to go, right? If it's that type of day for me to put on exposure. So focus, that would be at that point I'm focused on my focus list. So I few ways to do it. If you're working full time, you can set alerts, right? If you're working full time, we spoke about you could set buy stops and do a lot of that offline as well. We spoke about that in the previous webinar. But when the market's open, I'm focusing on my focus list because that's why I built it. It's my best chance to make good decisions that will lead to profitability for me in the markets, right? So that's what I'm doing. If let's say I have my focus list and it's a progressive exposure day for me, and the market's gapping up. Now it's thrown a wrench in my plans, right? My game plan is kind of thrown off. Then I need to have that should be part of my game plan. If this happens, then I can sit back and just watch, right? Okay, I missed it. I missed it. I need to still focus on, how I can best manage risk. And in a couple of days, the market will be back. It will be back in my wheelhouse because I'm confident. It always happens. You just have to wait for it, and when it is, and then I'll go and execute. So that's what I'm doing. 9:30. For me, my execution is usually, in the first 20 minutes. I know it's not. I don't want to say I know, but I have a feeling of what's going to happen. That's just through seat time you could tell, right? Hey, today is Wednesday. The Fed are supposed to say something at 2 p.m., right? Um, and the whole market is not going to do a whole bunch, right? It's basically going to wait for the Fed to come. So those type of that you build that over time, or it's Tuesday, Thursday, the CPI numbers are coming out and everybody's watching those. We're not going to get much action into that type of market as well. So usually, I by first, 20, 30 minutes, I have a really good idea. And then if I need to execute something, usually for me, it's within the first hour. Some people call it amateur hour. It's the only hour I tend to make decisions. It's very rare for me to make decisions intraday, like middle of the day type of thing. But that all boils down to type of trader you are. I know traders that won't trade the first hour and only trade, after the first hour. So whatever works best for you. the way I put things for myself, I trade best when I kind of anticipate direction and I get it right and I'm right in a big way, then I make a lot of progress, right? Or if I anticipate wrong and market moves without me, I just go back and say, hey, today's not my day. I just gotta wait and wait for the market to come back into my wheelhouse so I can, execute when I'm most confident. So
Yeah, let me jump in here for a sec because
yeah,
I think a key question people have is, what is the best time to execute? And, we've talked about Rai does mostly the first 20 minutes. I'm pretty similar. But, I know a trader like David Ryan, he said that he waits to see how things come back in intraday before putting on positions. So just like a lot of the stuff we talked about, there's nuances and
a lot.
there's a process of figuring out what's best for you. Stage three traders may have a sense on a day where there's an expectation breaker, a start of a cycle is happening, and the lowest risk spot is 1 minute after the open. Like that could be true. So as stage one and stage two traders, just take a look at your trades. Figure out what works for you. There's a lot of trial and error. When I first started, I actually set up a rule for me that I can't trade in the first 30 minutes because what I was doing is I was over trading a lot during those first few minutes where I would enter, immediately stopped out, buy back, it stopped out again, and then it would go without me. Like I,
We've
I,
all done that.
I saw that in my results. I would take loss after loss after loss doing that. So I made a rule that I basically can't do that. But I've now removed that rule because I've gained some experience. I have a better feel for, breakouts that I can anticipate that are going to stick, that type of thing. So it's a matter of figuring out what works for you in your position with your experience and all that. Any time can work. There's people who anticipate stuff, buy into the close, but it's a matter of your own personal style. I think is the big thing, and just figuring out what works.
Yeah, let's talk a little bit about, let's say, like you have a position and you have a pivot and it triggers, right? Like it goes above you set a price of um $20.50 and price moves through it. I guess what are some of the things you watch when it goes through your pivot? What goes through your head when it's actually time to make a decision? Hey, I'm gonna buy it or I'm not gonna buy it.
Are you asking me? I didn't catch
Yeah,
the
I'm
beginning of that.
asking.
Yeah, yeah, yeah.
You can
So
start and I'll add to it.
yeah, sure. So we talk about that at the end when we do have a deep dive in trade
Yeah.
execution. But it as a stock is moving through that pivot, first thing is, can I manage risk tightly? Usually within 3%. Is there a logical stop loss that I can place? If so, that's kind of the first green light that it has to pass. Then I'm looking at how is the rest of my focus list and my wider list doing. I just take a sneak peek at that because if those are all confirming and they're all expanding from the open, that means kind of breadth is with me and I'm kind of riding that tide if I enter there. So I'm considering that as well as the volume run rate. Volume run rate is the kind of time of day. How is volume compared to the average at that time? I saw a question about that. What's volume run rate? So it gives you a sense of, is volume happening a lot faster than usual? Is there a lot of interest? If both the volume run rate is high and there's group confirmation and gross stock confirmation, I just kind of place my order as it buys through that pivot. So with those two things are with me, I'm confident in my edge. And if I can manage risk, I go for it if it's a planned trade. I'm not waiting for volume itself, not volume run rate, to be above a certain level. I'm not waiting for it to be 1% of pivot to confirm the pivot. My risk is the least as it's making that move through that level, and ideally I get a lift throughout the day as we'll get into later on.
Yeah. So for me, I mean, over the years, I've just really simplified it to price. I used to do the whole volume run rate. It has to be high, above 1.5 or 150%, right? Etc. But it came to a point like sometimes it's high, sometimes it isn't, sometimes it adds more conviction to your position size real time, sometimes it doesn't, right? So it's an element that's variable that affects more my position size than it does my decision. right? At the end of the day. So if I expect that, hey, price is going to break through and volume's not so great, well, I'll execute based on the position size, 10%, 15% initially. If it's breaking through and the volume is 200%, yeah, I'm gonna pile in a little bit more, right? Closer to 20, 22% for that name. So only other thing I'm watching is the group up on that day. I think that adds a lot of momentum to the name. Like we spoke about, 37% of the move is based on the industry group, 12% is based on sector, and 3 out of 4 stocks follow the market. So just those three stats always stick at the top of my mind. And then the individual name itself, which is the volume run rate, how many people are actually buying and going in at the same time. All those layers will either deepen my conviction or keep me at this base. I can only put on a 15% position. If those three all align, then maybe that 15% goes to 20% real time as I make that decision, right? Even though I planned when the market was closed that, hey, I will put on a 15%. These factors kind of add or subtract from my conviction. So um, this one, preparation, ready for the open. I think we already covered many of these, right? Um, have a good broker. I think that's key. I know we haven't talked about this. I use IBKR. Richard, I know you use IBKR as well, or
IBKR and Charles Schwab are kind of my
Charles
main two.
Schwab. Yeah.
Yeah.
So there are many good ones out there. A lot of you that are mobile, I don't have we don't get paid or anything, but I use IBKR. I've used it for many years. Sometimes you get frustrated with it, but 95% of the time it works really well, especially on the phone if you're on the go. I still, to this day, it sounds crazy, but I place my orders on the phone. I don't like their desktop app, so I have everything planned. I'm not trading tick level, nanosecond timestamp type of stuff. So if I want to put on a position, it's great for putting on, even 10, 20, 30,000 shares relatively quickly, and you get a decent fill as well. So that's something that's key. Yeah, like dog walk, meditate, like you have a life to live outside of trading, like we've said in many webinars now. So you want to get your daily routine done and do those things. Those things will help you trade at the end of the day. Don't think of them as if I'm not spending time and, literally burning myself, burning my brain and not taking time off, it's going to lead to a better result. It just doesn't work that way. You need your that 9:30 to 10:45 is how fresh your brain is, how quickly you can decipher information that's coming to you, and how quickly you can make a decision, a good decision, right? And if you don't sleep and you don't do these other things, you won't make good decisions at the end of the day. So
Yeah, a few things I'll add here before we move on. I think I didn't realize that was a video. Very cool. It's mesmerizing. But yeah, sleep is really important, especially for me on the West Coast now. If I have something going on the night before and I don't sleep well, I kind of keep that in the back of my mind, and I'm not as aggressive the next day just because I know my decision making might be a little bit more dulled. I won't be able to react as fast. So do the things that you need to keep your body in shape, mind in shape. Take a walk in the morning to kind of open things up. I think I saw a study where your brain activity after a 10-minute walk is like it lit up the MRI screen versus just sitting down and in place. It's there's a lot less activity go on. So get moving. I think that helps a lot. And I would also say have a standard spot. Rai, I don't know if you do this, but I've got kind of a standard spot where I trade, where it's on my couch, on my laptop. So I kind of know when I get to that area that, hey, it's focus time. This is my spot to do this. That's kind of an important part for me, because that will dramatically impact things versus if I'm lying down or whatever. Have a spot, a dedicated spot for trading, a little station set up. It doesn't have to have 50 monitors. It just has to be it has the bare minimum that you need. So that's what I add here.
yeah, I think optimal setup is also something to talk about. For me, it's just my phone. It's always charged. A laptop and an extra screen. Like I don't have 15 screens I'm looking at. I don't. I know some people tend to, have giant screens all over and have indexes up all day. For me, that doesn't work. For you, if it does, great, go buy screens. But I'm more so when the market opens, the more I'm focused on that focus list I've created, uh, the better I perform, right? So uh, that's kind of, another thing. I'm always standing up at the open. I don't know. For me, it just keeps me more concentrated, so I'm not like slouching over or something. So I'll raise my desk and I'm standing. Usually the first 45 minutes. I know people that are working. If you can't watch the open, obviously you have to set other methods, right? Buy stops, sell stops, etc. Those things as well. But find those little tweaks to, what helps you focus, what helps you um, get your mind off of trading, and then get you focused when you are executing as well. So um, let's get into a list, trade execution, list sorting. Richard, if you want to cover this.
Yeah, so this is kind of my process in the morning. Say this is my wide watch list for the week. I have my column set up in deep view where I'll draw this on the screen here. Annotate, and oh, they changed the animation. I don't know how to use this, but anyway, I've got price percent change column, daily closing range column, run rates, and then price percent change from open. These are kind of my four main columns, my actionable columns that I'll click the top of the header here, and then it sorts my list from highest to lowest. So I immediately know, hey, this stock is up most on the day. Hey, this has the highest closing range on the day. So I'll switch in between those depending on the situation. And price percent change from the open, I think, is an underrated data point that I don't see a lot of people talking about, but I don't even know how to raise. Oh, here we go. Price percent change from the open, it's such a awesome data point because it tells you immediately this stock is moving from the open. Say we have a gap down and the market begins to rally. Sorting by this column, it's a cheat code. There's not many cheat codes, and it's not, obviously it doesn't work all the time, but it tells you what's immediately responding the strongest, what's under accumulation from the open. So I think it's really underused, and it's one of my favorite data points
It's
to
like
sort by.
a
Yeah,
stock can be up 5%, but down 4% from the open.
exactly. Yeah.
So even though the gap up accounts for it, the momentum from the open for that is to the downside. So that's what you want to be, cognizant of that fact that it's pulling in quite a bit, even though it's up on the day. That's where, price percent change versus from open are very different. It gives you intraday momentum and a
Yeah.
feel for what's going on as of, 9:30 and onward.
Yeah, each of these four columns are a different way of
Yeah.
assessing strength of a stock on a day. I've also got a column that's above VWAP for the day, the daily VWAP. So that's what I'm just alternating using, and I think it's a good framework to start for anybody. If you're not, sorting your columns, I think it's definitely something that you should try out to see if it helps identify that strength early on in the session. There's a lot of questions, which breakout do I take? The one that's the strongest based on these metrics. That's a way to choose.
And also DCR, I think, is a really good visualization of
Yeah.
you could get a quick glance of, hey, is my focus list acting well, right? That's why we built that into to trading our deep view. We also have weekly closing range as well. I think that's a good one on a weekly basis. Hey, what's going on? What's going on from Monday to Friday, especially in your weekend routine? I take a look at the ETFs list that I shared in previous webinars and sort that. It will give you a really quick view of what happened for the week, which one's acted strongest, which one acted the most weak.
Yeah.
So
And just for people who aren't familiar with daily closing range, you basically you look at a single candle like this one here. You've got the high, you've got the low down here, the open over here. Sorry about my terrible writing skills, but where this closes, where the current price is within the range from the high to the low, gives you that closing range where if it's closest to the high, it'll be near 100%. If it's near the low, it'll be near 0%. So just like the price percent change on the day can be misleading because the stock could be gapping up 12% and then it's down from the open 8%. You could be up on the day but have a closing range of down here, and that tells you that selling pressure came in that push the stock down from the high. So the closing range, really, really great great thing to look at. And I love how we actually have a visualization of the candle in Deep View. This is one of my favorite things that Nick thought up, where MU was down on the day, but also it was well off highs of the day. It only had a 12% closing range, while P Core was up slightly, but it was right near the high of the trading range. So it's another way to kind of analyze the strength of a stock. So yeah, these four columns, highly recommend setting them up and giving them a try to sort your stocks by right near the open or throughout the day.
So 10:45 to 3, yeah, for me, I'm just, kind of monitoring what's going on, looking at what, I'll go to my ETF list, take a look at what's going on there, go through my universe a lot, but basically universe is all of my watch lists combined into one list automatically in Deep View. So I go through that list a lot just to get a feel for the markets. I know Ross, if you ask Ross, he's constantly resetting alerts throughout the day. So as they trigger, he could see the rotation happening. So if a whole bunch of semi stocks trigger to the upside on his trend line alert, then he knows that semis are on the move. And a lot of his positioning that he does is based on it. So find whichever way, but have a way. If you can't do this, can't be at the desk. You don't have to really be at the desk. You could set a whole bunch of alerts and on the fly, kind of with our mobile phones and stuff, check where price action is going. Or if you want to, if you want to build your trading to be end of day, you don't have to do any of this. To be honest, like I know traders that only look because they work full time. They can only look at 4 p.m. when the market closes or 5 p.m. or when they get home. That's perfectly fine as well. Adapt whatever time that you have to dedicate to the markets and tweak your methods and processes that will allow you to perform within those limitations that you have, right? So this is not to say you have to do this. You have to be at the desk 10:45 to 3. Most of the time, I'm not really doing much. Maybe I check in midday to see what's going on. If it's, things are looking fine, then there's really not much to do. Then you keep, checking back in every now and then. I know traders, as day traders, that's all they do, 9:30 to 4, they eyes on the screen. They need to perform. They're day traders. They have to get an income daily. That's the benefit of swing and position trading is it's a lot more offline. It's a lot more end of day. It's a lot more less real time, more, when the market's closed as to how you plan your actions, right? So if a stock's coming in and it triggers my stop loss, get a notification, your stop loss is hit. Okay, awesome. I planned for it. So it's all offline for swing and position traders. So I'm not doing anything fancy. There's really not much to do after the first hour and a half, I would say. I'm just following stuff. Mostly universe list, focus list, going back and forth. And flipping those charts.
Yeah, during this time, same as you, I'm kind of getting other work done, walking my dog, eating lunch and letting my alerts kind of let me know if anything significant is happening. A lot of stuff for me. First hour, last hour are kind of the key periods during the day for me.
Yeah, and you will hear a lot of people say, good trading is boring. It is. It's supposed to be. It's not really exciting, or you don't get all juiced up and like all of that stuff. None of that happens. It's just very simple. You just execute and you monitor and you watch. And 80-90% of the time you monitor and watch. And that 10% of the time where you need to act, you act. And then you set your stops and let it play out, right? Sometimes you anticipate weakness and you sell early. Sometimes you anticipate strength, and you sell into strength. But most of the time, like it's very boring. You have to, I'm saying boring and not that, just you just have to do the you have to do the work and the research most of the time for you to go press buy and stuff. It's not as, you know, you don't wake up, buy stocks and then an hour later sell them and then go buy something else and an hour later. That type of style, especially for stage 1, 2 traders, that's what they're doing, right? They're acting way too often, even though their inputs are not saying or allowing them to act, but they refuse to listen or have a game plan at the end of the day. So 3 to 4, yeah, I watch the close. I watch the last half hour. I don't watch the full hour. I think it doesn't really give me any different information. So I watch the last 30, sometimes 15 minutes just to see how the close is. So if it's a bad market, you're going to close weak, right? If it's a good market, you're going to close strong. If it's a market that's reversing trend, the closes are going to be good and get better as you switch from a negative market cycle to a positive. I'm looking at I start looking at my positions and I start scanning actually 20 minutes before the open. So I kind of get started a little bit ahead of time, and then I usually finish by 4:30,
Before the close, you mean?
4:45. Yeah.
Yep.
That's pretty, yeah. I mean, there's nothing different. I mean, I don't like to place positions, new positions at the close. That's just my style at trading. Some people do, some people don't. And yeah, it's pretty much the same for me. I just start scanning at 3:30 though.
Yeah.
So
What for you if you place a position in the morning, um, and obviously this is very market dependent as well, but what type of profit cushion would you want at the end of the day, and what are you willing to hold overnight, uh, if it's not quite enough?
yeah, let's say we're early in the market cycle, right? Plus day one or day two, and the position is flat, and I bought something and it has made no progress. I will keep it because we're early in the cycle and I'm anticipating breadth to increase. When my market cycle system says breadth is supposed to increase the first 3 or 4 sessions, right? Of every new market cycle. So I'll keep that position. If we're later on in the cycle, let's say day 21, 22, and I'm not expecting a big increase in breadth, it's more you move towards, you have to specialize and move towards setup. So you have to pick the right ones later on in the trend, whereas early in the trend, everything's moving up at once, right? So later on, if I put on a trade and I don't make progress, and if it's up maybe 1.5%, 2%, then it depends on that individual name. How is the average daily closing range on it on a 20-day basis? I'm up 2%, but on average it moves 5 or 6%. In that situation, it's really situation dependent, right? I might sell it in that I didn't get traction, the traction I was anticipating or wanted, it didn't do that, so I would sell that. So it's all for me, it's relative to where we are in the market cycle, is how I do it. Yep. Perfect. So any questions? I don't see much.
Yeah, Claude, for me personally, I like new positions to be positive and at least have a good closing range as well. But it's very similar to Rye for me. Yeah, I think we can keep. I think we can move on to the next part here.
So post market, like we spoke about, you have to go through the steps that we highlighted, right? Review your position. So this is key. You should know exactly what you're doing as soon as the market closes or as the market's about to close, right? Or anytime. If you want to do it at 7 p.m., 8 p.m., 9 p.m., 10 p.m., there should be a finite like amount of time that you're going to spend on, not, hey, I'm gonna get started and maybe in 3 hours we're gonna be done. That's not a routine. That's, you're dragging your feet and you're not gonna get anything productive out of that. So I review my positions. Do if I made a trade, I take a look at, was it according to my game plan? I do that right away. It's almost like a mental thing. Do the market analysis, the group analysis of key stocks. So go through my universe list, go through my focus list, update my if a watch list needs an update, I go ahead and update it. Post market screens, if there's earnings season, right? A lot of stocks are gapping up, gapping down, reporting earnings, news related stuff. quickly take a look at that, update my watch list, and then create my daily focus list, which is a small tweak based on my weekly. And all of this for me takes, 45 to an hour. And then if it's a good day, and I want to continue to, kind of see what happened, maybe I had a bad day executing in the market. So I screen a little bit more, plan a little bit more, try to get out of that, bad decision making streak. I may do that, but again, I'm very clear on what I'm doing. I have these 6 steps. I will follow them. I'll finish it. So I get that portion of it done and I'm ready for tomorrow. Right. And when that's done, then you can go out, people tend to do different studies. They tend to, look at different things. That's perfectly fine. But have these steps, the big process that we showed you from the TL subscriber at the very beginning, have that visual map and just execute it. That's the only thing, like just tunnel vision, do that, get it done, have it ready. You'll feel more confident already, and then you're prepared for tomorrow. So
Yeah, and step 7 for me is go play soccer. So
yeah. So after that, yeah, that's probably the most important one because as you take your mind away, the way the brain works is it's going to, wire. It's going to help you a lot, and you'll sleep on it. You'll wake up. You'll have the daily plan in the back of your mind and on paper if you choose to do that, and your decisions are going to be so much better as well. So again, review positions. We've spoken about this. Plan for worst case scenario. Focus more on the loss. Yeah, this is more important. A lot of stage 1 and 2 traders say, hey, this moves up 20%, I will do this, that. Focus more on if this moves down 5%, goes, if it hits my stop loss, if it gaps below my stop loss, what am I doing? That's more important for you guys as stage 1 and 2 traders than to focus on the gain. The gain will come. That's the good part. That's the happy part of trading. The work, stage 1, 2, you're losing money. Focus on how to minimize that loss instead of maximizing gains at that point. Post-trade analysis. So a lot of this is, you could give yourself a quick execution score. Hey, this was my game plan. It was a risk management day. I managed risk and I didn't place a new trade. That's a huge win. That's an A+ day. What stage 1 traders do is it's a risk management day. I place 3 trades and all 3 of them are down. So you go in with a plan, you didn't follow that plan, and then you lose money on top of that. That's stage 1, right? A decent day might be, hey, I executed on a trade, I put on an order, but I was a couple of 50 cents, 60 cents late, and my execution could have been a little bit better. That's where you could be a little bit harsh on yourself. But you could grade yourself. I think if you have a proper game plan and you follow it, and you stop yourself from yourself and you define the type of day you're going into and you execute upon that, you want to build a streak of A+ or A day, execution scores, because that is going to pile up. It's another positive input to your psyche, and you will be better because of it, because you're not going to deviate from your plan. And they should be no more than 1 to 5 minutes. We're not, don't get too official with this. Again, we spoke about daily market analysis. I tend to go through S&P 500, NASDAQ, Russell, look at equal weights sometimes, look at some people look at breadth metrics daily, right? John Boyk is big on that. Net high lows, momentum scores, market cycle. Where are we in the market cycle? Are we expecting an expansion or a pullback? You do your post-market screen. So post-market screens that I like to run, and Ross is big on this one, is up on volume. Liquidity is one that I run, show me all stocks that traded more than 5 million shares or 6 million shares. I just tend to go through that list, usually 150 to 160 names. Gives you a really good feel on the stocks that are trading the most volume, what are they doing, and post-market gaps. So earnings and news. So what are things that are gapping up? Is the semi space going to be hot? Is the tech space going to be hot? Is what's moving post-market, basically. So earnings are big, with the high volume edge that we spoke about. It's very key to keep track of earnings and then continuously update that watch list as well. Richard, any scans that you run that are not listed here?
yeah, I go through every stock in the deep view universe. So I kind of sort by percentage gain on the day. And that not only helps me like find ideas if I miss them and I'll add them to my focus list, but it also gives me a sense, hey, I'm noticing this group all performed really well. That group was strong today. Oh, this group's kind of falling off. So it's kind of two things. It's idea generation, but also gives me a sense of the market health and all of that. So that's kind of one of my go-tos, and I'll sometimes also take a look. I've got a screen that's just kind of high momentum stocks, top 5% of absolute strength score, and I'll take a look at that to see if there's anything that really moved that day that I might have missed.
Perfect. So yeah, update watch list. Whatever watch list you maintain, update those based on either your scans, right, your post market scans, or if you have, you should have very specific scans like we spoke about in the last webinar that allow you to update these. For me, I maintain the gappers, the IPO, and momentum. I'm not scanning for IPOs on a daily basis. I think that's a little too much. If there is an IPO, I'll hear about it like from the team itself. But we update the IPO list and then momentum. These are usually weekly updates for me, but more so the gappers is the daily one that I update every day because their earnings, if they're gapping up on earnings, I want to see day two and execute upon those. So trade execution deep dive. Richard, if you want to go over this.
Yeah, sure. And before we jump to this, I'd be curious to know in the chat if you guys could list out the key screens that you use every day. I think that'd be good. Idea generation for everybody in here. So, all right. So trade execution, we've touched on this, and we're going to dive a little bit deeper now. For me, prerequisites before I even think about trading that day is I've got a daily focus list set. The market analysis, where we are in the cycle, the overall health says, it's okay to be aggressive. It's okay to look to accumulate new positions. I've got my game plan set for each stock. That means I've got my pivot point in mind, my entry tactic, my risk management set, and I've got alerts ready. So I'm letting the computers do the work, and I'm ready to go. So this is kind of like the bare minimum. If I don't have this set, I should sit out that day. So moving on to the next slide here. Pre-market, I take a look at pre-market action of my daily focus list as well as the wider weekly list. I set and double check alerts. And for me, if I've got a pivot in mind, say at 100, I'll also set alert at say 98, 99. So I'm able to bring up the chart of the stock that I'm watching as it's moving towards that pivot. I think that's key. If you just set alert at the pivot, you're not going to be able to enter at that pivot, and your risk is going to be a little bit wider. And just in general, taking a step back, sometimes stocks move really fast and they're bursting through the pivot. For me, I never want to enter a stock more than 1% past kind of the ideal pivot buy point for me. You can kind of set that value for yourself, but keep that in mind that you don't want to enter too extended from that proper buy point. Then also what I do for any stock on my daily focus list, I kind of visualize, if this happens, I'll enter. What's it going to feel like as a stock is breaking out? What am I going to be looking for? What does a successful breakout look like? What does a failed breakout look like? So I kind of think through the mental processes beforehand to kind of think about, what can happen and how will I respond? Rai, is there anything pre-market that you do that we kind of haven't already mentioned here?
No, I think we've gone through this.
Cool. So yeah, once again, the market's open. Now I go ahead and sort by percent change from open, for, volume, run rate, all this stuff we already talked about. As alerts come through, early alerts or pivot point alerts, I'll take a look at them. We've got a really cool alert system where it gives us the price surge, which is the movement of the past 15 minutes. Gives you a sense of momentum right there in the alert. Then as the stock moves towards the pivot, I'll either prep the order with my broker if I'm looking to actually act on it, and I'll wait for that pivot point to happen. And I'll also take a quick peek at the weekly list to see, how's the group doing overall, how are growth stocks doing overall, again, to kind of get that group confirmation that it's risk on that day. Then, so these are a few questions I've seen people ask. I take the first stock to go if they're all kind of equal potential. Maybe on a day, I view NVIDIA as the leader on of the cycle, and another stock that's a little sub quality, I'll let that go because I only have a certain amount that I want to be exposed in addition that day, and I'm focusing on NVIDIA versus that stock. But that's something you have to think about in advance. Once I actually enter the trade, immediately I set a hard stop in my broker. I know some people do it differently. They'll set an alert versus a hard stop. I always have a stop in with my broker, and I'll set an alert just below the pivot buy point and a little bit above my stop loss as well. So I'm kind of warned again if the stock kind of starts failing the pivot and then approaches my stop loss. So getting into a few different scenarios as a stock moves through a pivot, we're going to run through a few different ones. This to me is kind of the ideal scenario where the stock, as soon as you buy it through the pivot, immediately goes, makes progress for you. Things are looking good. Is at the highs of the day. All of that. Stocks in the group and overall growth stocks are acting well on that day. Breadth's expanding. This is kind of the ideal scenario. The stock trends above the daily VWAP and closes strong. This is ideal type action. When this occurs, less is more. Let the stock work. Ideally, the next day and even the days after that, we see more and more additional fall through, and we'll touch on that in a later slide. So this is kind of the ideal scenario. This doesn't always happen, but when it does, I've found personally that these are kind of like my best trades. If day one the stock acts great, I've typically gotten my best trades from a day one that starts like this. So this is an example. We've got a CrowdStrike set up here. It pulled back to the pivot, made some progress. The group was acting well. We had an outside day the day before, and you've got a pivot at that high of the day where the dotted line is right there. So this is kind of the setup. It was acting well. Then moving on to the next slide here, we see the ideal type action. It immediately rallies from the open. So again, if you're sorting by that in your column, you'll see the strength right here. Volume run rate was high, and then we've got a 15-minute chart on the right-hand side. You can see the immediate rally off the open through that pivot, and immediately there's no give back. It's trending above the intraday moving averages. If you've got a VWAP on there, it's trending above that. So this is a great example of an ideal type buy where it breaks through a daily pivot and even breaks, through the base pivot, which is well above that. So you've got people who are buying at that base pivot, adding fuel to the fire, as it were, and you've already got a nice profit cushion going into the next few days. So the next scenario is kind of a stutter step scenario. The stock moves through the pivot, but then it kind of hesitates. There's not really conviction in the move. It doesn't really trend. It kind of oscillates up and down. It might undercut the pivot a little bit, try to re-break out, fail again, undercut, try to move again. And it's kind of a lot more trendless intraday. There's mixed action from the group and growth stocks overall. The stock is kind of trendless, may undercut the VWAP, and it might close mid-range or barely above the pivot. For me, the action in this case is try to give the stock time during the day to see if it can start trending. If it isn't just a clear pivot failure and really, fails on high volume, and ideally, I want to wait until the close to make a decision to keep the trade on if possible, especially if we're in a strong market. If we're in a weak market and a stock stutters at the pivot, I'm likely cutting that as soon as it stops working. So we've got an example here. I think Rivian, yeah. So a lot of people are watching the September 8 type area where there are a few times where it tried to break through and couldn't. The group action was kind of mixed at this point. Growth stocks in general were mixed, and it stuttered at the pivot a lot, a few days in a row. I tried it, cut it, and then ultimately it kind of pulled back, undercut this range. It's now reset a little bit, but the stock just wasn't ready. There wasn't really conviction in the pivot breakout. And with a pivot, you want the stock to just go and make profit for you. So when the stock stutters, it's a reason to be more cautious. Sometimes it will stutter for one day and then really break out the next day. So a stutter doesn't mean you take it off your watch list. It's just a little bit weaker and you have to watch it a little bit more carefully. All right, failure and reset scenario. The stock moves to the pivot but fails almost immediately. I'm sure a lot of people have experienced this. There could be poor action from the group and growth stocks at large during this failure. And the stock, after this fails, it kind of regroups, sets up another entry tactic later in the day, and the rest of the market confirms. Maybe FOMC minutes came out and all the market kind of lifts up off the bottom, tightens up again, and it approaches that pivot again. I would say advanced traders can look to enter using another entry tactic if the overall setup is still valid. But for beginner traders, this is where you want to take a step back and just kind of avoid, because it takes more nuance, a little bit more advanced analysis to re-enter a stock like this.
And it also takes a little bit of you don't want to be in this loop where you buy, sell, and
Yeah.
then you buy again, and then pull it back, and you sell, and then you think something's wrong.
Yeah.
In terms of the market's against you or something like that. Usually that's not the case. It's just that what you're doing is not working. So to avoid, this whole like year 1 to 5 or year 1 to 6, I used to do this a lot too, where I would buy and then sell at a loss, and then I think it's a buy again. And I would make multiple buys throughout the day and continue to hurt myself. Uh, and you learn from that, right? You say if it's failed and it's done, and I shouldn't go back in and then get punched again. And you take several punches instead of one punch, and you're in you're in worse shape than you really should be. So
Yep. Next possible scenario is just a straight failure. The stock moves for the pivot but fails quickly, potentially on increased volume. There's poor action at large, and there's kind of no sign of a rally attempt. Advanced traders can cut it, almost based on feel as a stock is failing. All traders should make sure to obey their max stop loss, because on a day like this where maybe the market gapped up, everything fails together, it can turn pretty ugly real quick. So you just have to be ready. This is ESTC. It tried to push through the pivot, failed that pretty quickly, and ultimately pulled back a little bit further. And we'll have to see what happens later on with this one. We've got a gap up scenario. A stock gaps up through the pivot. I'm sure everybody's experienced that. They've got the perfect pivot in mind, and the stock just gaps up. And now what do you do? So basically, you need an entry tactic to deal with this. So ideally, many stocks are gapping up together. There's kind of an expectation breaker in the market at large. Maybe the prior day ended at lows, and now we're gapping up. We're potentially starting a new market cycle. All of that. The stock immediately moves higher and has an opening range breakout. Advanced traders can use this type of entry tactic, managing risk tightly, while stage 1 and 2 traders, depending on your experience level, should just kind of let gaps go. If you plan for a normal pivot breakout, you don't want to just chase a stock on a gap, because potentially it could fail, and you'll take an easy stop.
yeah, and also at stage 1 too, the more that you trade within your expertise that you've built so far, the better your results will be. Whereas 99% do the opposite. They try to do what stage 3 traders should be doing because they feel like mimicking a stage 3 trader makes them a stage 3 trader. That's never the case, right? So when we say let gaps go, that might be a little tough for most of the years in here, but you have to do that. You have to if it goes, it goes. There's so many other stocks and opportunities that will come along. And if you don't stick to your expertise, yeah, you could go and buy a lesser position size, right? Instead of maybe 10, you go with 4. Hey, I want to learn this area of the market, but you don't go in with the same position size, and when it pulls back, you hurt yourself, and then you continue with a downward trending equity curve. So
Yeah.
this is a good example here, NVO.
Yeah, so NVO, I know a lot of people are watching this. It gapped up nicely. I believe it was a news event, but it sold off right at the open. So, if you're a beginner trader and you're, it's gapping up, it's going to solve diabetes, all of that, you were likely stopped out, or your immediate loss, your mentality's kind of shifted. But more experienced traders can wait for kind of that low risk buy point to present itself, where it formed a short-term range, a clear level, and ultimately kind of catch on this 3-day move that it had, which is pretty nice. So Yeah, if you're trading gap ups, make sure it's within your expertise and you've got a clear system for doing so. I know Brian Shannon's got a tactic: gap, buy the gap up or wait for VWAP or something like that. I'm not saying the rhyme right, but basically he waits for an anchor VWAP or retest after the gap up to kind of manage his risk again. So have a process if you're trading these type of scenarios. Then, of course, we can have a gap fill reset where the stock gaps up the pivot, but then reverses down, fills the gap. It can then set up intraday and act strong along with group and market confirmation. Again, more experienced traders can use their original plan entry and risk management plan. But if this wasn't in your plan and you're a stage 1 or 2 trader, don't touch it. Just let it be. Let it set up again. And we've got PLTR. It gapped up slightly here. This wasn't the best example, but it's what I could find. We've got a gap up on that day. It fails. We've got the 15-minute chart there. You can see that red bar. It fails, pulls back into the range, and then goes and breaks through that pivot. So this is an example of it basically gaps up to that pivot, fails, forms a range, and then rallies strongly. You see volume pick up, all of that. And this led to a really nice move over the next few weeks. All right, gap up failure scenario. This is where it can just fail completely. The stock gaps up through the pivot, but then reverses down and fills the gap. There's continued distribution, continued selling. The group and market are also seeing this together. Action is just kind of wait and see, wait to see a strong setup and reversal, not just the stock, but the overall market and group, especially if the market was short-term extended before this gap up. That's part of that situational awareness where you're taking that into account. Then a quick note on follow through. So this is kind of for the day after you've bought a stock and established position. Ideally, what you want to see is a strong close in that first day, but then you have successive days of progress being made, closes near highs, constructive action, tight action, reconfirmation, all of that. What this does is it's a sign that you were buying at a point which was very strong, where institutions were accumulating. There are a lot of market forces coming together. They're all trying to fight for those shares, build positions, and this creates a cushion for you, immediate progress. And with that cushion comes a lot of options for you. You can sell into strength. If you're more of a swing trader, you can move your stop loss up if it's at a multiple of your risk. You can move your stop to break even. All of that. When we've got this follow through and cushion, it's ease of mind as well. You're like, all right, it's acting right. I can let it do its thing, wait for the 21 EMA to cross my cost basis and kind of switch to my position trading rules. And I found, again, kind of my best trades had that immediate follow through. This is an example of lack of follow through where the trade fails the next day. This is RYTM. We have a nice close that first day, and then the next day we try to move higher and immediately just slams back down, breaks back through the pivot, and this declined, I think, 20% over the next few weeks. So stagnating at the pivot or quick failures are definitely negatives, especially if the failures occur on higher volume than the breakout. But even with failures, you want to keep an eye on them because they might just lead to the next setup, and then you've kind of shaken out a lot of traders, and we might see the accumulation come back in. So it could just be that the stock or the market just wasn't ready on that day. So what you want to do is move kind of these type of stocks to a separate watch list that you might review on a daily basis. This is AMR back in 2022. I remember I bought this right on that first green arrow. It made progress, was acting well, and then you can see in that one bar, let me see if I can draw it here, or maybe Rai, you can point it out. The one bar, we break below this range that it had been forming here. Here's kind of the low of that range. And then I took it off my watch list, and what does it do? It resets and forms a tight range. And thankfully, during my routine, I found it again. But if I hadn't been watching it, I might not have gotten a nice trade out of this where it tightened up again and set up again and led to a really nice move. So always keep an eye on these failures because it could just be that the timing just simply wasn't right.
Yeah, this one's a tough one to get a grasp on. It happens a lot. I mean, it it takes a lot to wrap your mind around something you were trading or even tracking. It fails, you take it off, and but you need to continue watching. I know Ross would wait for it to completely just get obliterated before he takes it off his watch list, and that's something I picked up from him as well. And over the years, you see a lot of this, like it's setting up perfectly, and when it looks perfect, it doesn't work, but then it remounts and then it keeps going after the fact. So this is a really key point where you're going to see a lot of those where a trade will hurt you, but don't take it personal against that particular name. If it sets up again and everything's lining up, you have to kind of take it again, because in this case, this was a move from 60, basically a double, right? 60 to 120. So
Yep.
next, I have a few examples of my recent trades that I have done, and I want to kind of sum up a little bit of the way I trade is day to day, week to week. It's not more so. I will track stocks over a span of time, and as I build that confidence over a few weeks of how that stock is acting, then I will start building a position in that. It's very rare that I know about a stock on Monday and by Wednesday I'm in that stock, but I haven't learned the personality of it or at least track that stock over a correction or or that stock not showing relative strength. So this one is CLS. It gapped up over here, had a poor closing range. So did the market on that particular day. So I kept it on my radar. And then the next day, you see an expectation breaker. So next day, you see volume is higher than the prior day. And the stock that opened up here and closed down here is now having an expectation breaker and close above the prior day's high as well. So on increasing volume. So that was an expectation breaker. It caught my eye. And then I kind of tracked this stock. It built this entire base as the market pulled in. This orange line that you see is the S&P 500 pulling in. And this stock had every reason to follow through to the downside, especially after this day, right? That's what we all expect to happen, for it to come in, fill this gap, and it's going to be dead and buried. And we know we will never trade it. But what this did was it continued to base above this $20 area as the S&P came in. That caused the relative strength line to continue to rise, right? This is in an RS phase that we've spoken about. It built a base above 20, and then now the stock's acting well. The second time, now we have the second kind of the September pullback. This is this year, September 2023. The S&P continues to pull back. So this black line I drew from the intermediate high that we had, this rally attempt that failed, all the way to the low of the S&P recently. So this is where it starts. That's this price action, and this is where the S&P made a low. And we expected the stock to continue its decline while the S&P was declining. But what do we see? We see that the stock is trading up here instead of down here. It should be around 22 or maybe even 20, given that there's a lot of market pressure. But what we see is a higher low, and the stock holding the 10-day and the 21-day. So this is where I kind of entered on this particular day as things were starting to turn back up, breadth metrics, etc., market routine, going through that. I placed the trade through, this on this particular day, and then I sold it on Thursday because we were anticipating a stress test. Now, this combines a whole bunch of things into one. One, how do you get this name on your radar? You maintain your watch list, you do your daily routines, right? Second, we just spoke about it. Even though there's a failure on this name, we continue to track it until it completely breaks down. It didn't. It had an expectation breaker. Third, we've spoken about having an edge in the markets. Relative strength is an edge. As the S&P pulled back over a span of from July to September, this name continues to trend up to the upside. So that's on an aggregate basis. That's relative strength. That's an edge in the markets, right? And this is the high volume edge. This was the highest volume this stock has seen in over a year at a minimum. So all of those things combined, things are lining up. You're tracking the personality. This is kind of how I trade. I track the personality of the name. I'm gaining more and more confidence that this name is under accumulation, right? So then, at this point, I entered that name because I felt like this was a spot where breadth was turning, goes up, and then I sold it into strength purely based on the fact that there's going to be a stress test. And that's where my market cycle component came into play, right? My entry was based on the fact that the market cycle is about to turn positive, and my exit was based on the fact that we're about to see a stress test, so I anticipate some sort of pullback on this name. Now, this is purely swing trading, right? But what I want to emphasize is this is all done offline. This is done through daily routines, going through the market on a day-to-day basis, maintaining the gappers watch list, and tracking this name as the S&P pulls back in and this name continues to rise. It gives me a trade, and now you profit from that trade. It could be a 2R, 3R, 4R, whatever it is, you make some significant progress to the upside on your portfolio or your equity curve. Another example, this one I've traded pretty well. It almost feels like I've learned the personality of this name just tracking it. So back in May, we had PLTR gap up into the 10th spot. We just covered that a couple of slides ago, the day that it went to 10, right? It gapped up on earnings, faded on the 15-minute, then U-turned, and then rallied 100%. Now it's gone into this bigger base. Same thing here, right? We get the September pullback in the S&P. This name goes into a relative strength phase, right? Relative strength phase means that this name is now outperforming the S&P or NASDAQ on a 21-day basis. And it's doing that consistently over the past 21 days. That's what happened on this particular day. So again, the S&P is pulling back, and I expect this name, this black line that I've drawn here, from the top of this candle that goes all the way down here, which says RS, that's the equivalent of this S&P pullback, and I expected PLTR to be somewhere down here, right? That means that PLTR should continue to weaken as the market weakens, but it didn't. So the fact that it doesn't do that, combine that with one of the recent calculations we implemented in Deep View, which I'm trying to make part of my process because I feel like it's a definitive way for me to define tightness relative to the stock's volatility. And those dots show up right here. It says, over the past 20 sessions, this is the tightest PLTR has traded. That's essentially what this is trying to say. That's where it caught my eye, because if this breaks this range, from tight areas, you get volatility in the market. Could be downside, could be upside, right? But the fact that I expected this to continue to decline, while the S&P was under pressure, this is an expectation break. It broke above that range. The market continued to pull back. So I started accumulating that stock, and I sold it, into strength, because it gave me, it was a smaller position. The market cycle count was still negative. I put on that position, made a little bit of progress, but I took it off as soon as we ran into the strength, came back in. But it really made it obvious when the S&P turned, or the NASDAQ, or the Qs, right? NVIDIA was above the 10-day. I had enough in terms of the market trend picture to anticipate that breadth is going to increase. These 2 days were really key, where it held above the 15 spot. We're in a relative strength phase. I put that position back on, it rallies up, and we get a 15% move. And then again, same thing. Market cycle count is closer to 4 or 5 days. We're anticipating things have moved 15% in a span of 5 sessions. I expected a pullback. I sold the whole thing because I needed to make some progress. I needed to see a higher equity curve. I needed, make some progress. And if this happens where it just went to without me, I still have this 20 pivot to work with because we're within that base, right? So there are different ways I could re-enter this name, but that progress I made from 15 to about 18.5 in a short span of time, you build these things where, hey, if I sell this, I will have ample, I've made progress, and we're so early in the market cycle. So I sold that. I'm kind of watching this name again to see if and when it sets up as we expect the stress test. We got that on Thursday and Friday of last week. And this one was really a perfect scenario. Like, it worked out perfectly twice for me, and things are not that perfect. That's what we'll cover in the next one. A losing trade from Friday.
Going back to that, Rai, for a second.
Yeah.
Can you go back?
Go ahead.
Go back to the PLTR chart there. Those 2 days where it accumulated over 15, that's a positive expectation breaker too. Because look at the prior day session. We pulled in hard, closed near lows. and we're expecting to fall through to the downside. And what happens? We have two tight days after a gap up. So just wanted to point that out there.
Yep. So the next one is this one. This one I placed a trade on Friday. So the expectation was again the same. It was relatively tight right up here. And the fact that we were anticipating a stress test according to the market cycle uh, on Thursday and Friday. So I let the name pull back in. So my anticipated entry, I had this planned out, was 45 bucks. I knew that if it gets close, if it's going to get close to 45.30, 45 area, I'm going to start accumulating a smaller position into this name to see how it acts, right? So I did that from 45.30 all the way to 45, and this name broke 45 the next 10 minutes. And I took the loss on that right away, pretty much. So it was 1.5% or 1.75% loss. It gave me instant feedback on Friday and said, your anticipated entry tactic of 45.30 to that 45 area. I expected that to hold. Market said no, it's not going to hold, and it flushed me out. It did two things. My execution was good because it was planned based on my daily routine. My stop loss was defined. I knew when I'm going to exit, right? And third, it gave me feedback that, hey, Friday may not be the best. What Friday told me was I need to be a little bit more patient going into next week. So all of those things, my execution score is still, I did what I planned. I exited according to my game plan. I didn't go into the whole world of, hey, it will come back up and things will reverse, things will change, etc. I took a loss. It was according to the game plan. I would do this again and again. If market continues to give me this negative feedback, obviously, you continue to scale down your position sizes as we spoke about in previous webinars. But I got what I wanted out of this, even though this was a loss within 15 minutes of executing on this trade as well. So that was one of the third examples that I had. Perfect. Any questions, Richard? I think that's the last slide.
Yeah, let's see if there's any ones here. Um, the deep view, the pink circles are RS new high before price. So the relative strength line is making a new high before the price action is. Looking at that same time frame, you can see over to the left in the base, we're not breaching that high yet, but the RS line is. So that's a key characteristic where it's kind of fighting the market. The blue triangles are the crossovers where the RS line crosses above the signal line, which I believe is the 21 EMA in this case
Yes,
of the RS line.
the 21. Yep, says right.
Yeah, perfect. Um, RMV is relative measured volatility, so it gives a sense of how tight the stock is versus recent price action. So it's a way to identify volatility contraction patterns. Really cool and only available in deep view. Perfect. I think I think we can move on and call it here. I think once again a reminder to
I see a
down.
good question
Oh yeah, go
on
ahead.
what time frame do you execute on? I tend to execute on I execute based on price, not a time frame. Like I look at the daily, I do my analysis on the daily, I look at the weekly. I do combine those two time frames, right, to get time frame continuity. And I execute based on price. I don't look at 15 minutes. I know Richard, you do, right? 65-minute, 15-minute
Yeah.
in terms of pivot definition.
Yeah,
Um, yeah,
for pivots, I like to look at the 65 because there's often some really clear pivots that happen
yeah,
on that time frame that aren't really visible on the daily, but they're still key pivots because they're not just noise at that point. The 65 minute is a really good time frame. But what I have during the day up is the daily and then a squished view of the 15-minute. I don't know what do you have on your
I have
screen when you're
daily,
executing?
weekly, and five. I like
Yeah.
to watch on the five as the day goes on. But my exit in terms of like what price am I gonna attempt to get is more so based on the daily chart itself, and then I just look at price throughout the day. But yeah, 65-minute definitely works. I know a lot of people that use 65, 78, 39-minute, etc. So
Yeah, and what's key there is, daily pivots override 65-minute time frame pivots. Weekly pivots override daily. The ideal scenario is there's a 65-minute pivot just below the daily where its price is contracted intraday on the 65. You enter when it breaks that range. You can manage risk really tightly, and then it triggers the daily. Then it triggers the weekly. So that's kind of the key reason here. But the higher time frames are always much more useful. I think for stage 1, 2 traders, focus on mastering the weekly and daily charts first. There's a lot of noise on intraday time frames, and I only use it in very specific scenarios.
Perfect. That answers Matt's question. Favorite journal app? We'll have a journal out very soon. There are a few out there. Trader Sync, right? Trader View, Trader anything. There's a lot of journaling apps out there that you could use. We are going to have one in Deep View as well. Obviously, I'll be 100% biased. I think it will be the best one.
Yeah, and the RMV, you can add it to your DView charts by adding the DView technical patterns indicator, and then the RMV is part of the package there. You can also add different, you can add, a lot of different indicators in there, 3 weeks tight, ants indicator, all that stuff. So, but it's part of that technical patterns package.
What MAs do I use on daily? I use the 10, 21, and 50 with the 65 sometimes if it's closer to the 50. That's something that Ross he uses a lot and sees a lot of success in it. So 65 EMA.
Yep. And I think the threshold to show up the RMV dots are using a 20.
I'm
What do you,
using a 1510. So 15-day look back, less than 10 for the score.
RMV? Nice.
Yeah.
Cool. Any other key questions that you want to cover here?
How do you add it? That's probably if you're in Deep View, you can join the Discord and ask Tyler, or just message the support. We should have a video on it as well, right?
Yep. All
How
right.
do, how do you stack probabilities in your favor? I think it's a good question. You stack probabilities in your favor with these three stats. Three out of four stocks move with the market. 37% of a stock's move is based on its industry, and 12% of the stock's move is based on a sector. So if you trade the top industry groups when the market is in an uptrend with the sector backing, your probabilities of being in a winning position increase quite a bit. And when you don't do that and you try to be bullish in a sector that's not moving up and it's a sole warrior, you're making things more dependent on that individual company and its story, which could work in some cases, but most cases it's very hard to do for stage 1, 2 traders. When do you decide to sell? That's a whole topic we will cover. I think it's very hard to answer in a few sentences. I don't see much else. This triangle is crossovers. So this blue triangle indicates that the RS line has crossed over the 21-day average relative strength line to the upside. So this is a visual cue that this crossover has happened. That's all. I don't see much else, Richard. Do
Yeah,
you?
I think we can call it there. Thank you guys all for tuning in. I think the next slide, just a reminder to check out the Ultimate Training Guide if you haven't already, as well as the Deep View tool. This is what both Ryan and I use to execute daily, and we're building in a lot of key features that save people time and help them execute better. So definitely highly recommend this if you haven't already checked out. Saw a lot of Deep View users in the chat here. So that's awesome to see. I think the last thing is, yeah, check out the Ultimate Training Guide. I'll drop the link one more time in here in the chat. Definitely recommend checking this out. We put a lot of work into this, and I think it will help speed up your learning curve. So with that, thanks so much for tuning in. Rai, any last words that you'd like to leave everybody with today?
No, check out the Ultimate Trading Guide and also the Ultimate Screening Guide that we mentioned at the beginning of the session. Share your feedback, etc. And then next Saturday's topic, I think, goes into journaling, post-trade analysis, and the depths of that. So that will be a lot of fun. So
Yep, looking forward to that. So thank you guys again for tuning in. For everybody watching the recording, make sure to leave a like down below, subscribe if you're new to the channel, and we'll see you guys in future webinars. Take care, everybody. Bye.
thanks, everybody. Have a good weekend.